Good afternoon, warriors. Hello. Yes. We're in the chapter called as. We're done with chapter number 1, right? We're done with chapter number 1. We're done with chapter number 2 also, correct? You were supposed to prepare some answers and give me. Can you tell me the answers quickly? Which questions are pending? Did we do question number 1? Okay, done. Question number 3? Done? Okay. 4 you were giving the answer. What is the answer? 9 lakh. 1 second. 983. 290. Is this the same answer for everyone else? Yes. 907. 890. Okay. Others? So, 9 lakh 19 919 990. Okay, that's all. Okay, let's try to figure out. My live chats. I'm keeping the YouTube live also open, so you can let me know if you find any challenges. Okay. Yes. Question number 4, right? Okay. Question number 4. What did happen? What is the total income first of all? 39 lakh 82 02 0. This is what your total income is. Let's split into slabs and non-slabs. Yes. What is our slab incomes? 1, 2, 3, and 4. Total all the 4. Sorry. 1880. 18 00 691. Is this the total actually, or is it after reducing the 3 rupees? Reducing 3 rupees 680. So you have to take after reducing 3 rupees, no? This is the question with the reducing 3 rupees, right? So you have to reduce it to 3 rupees. This is what it come. 18 lakhs 688. You are not opting for 115 BSc. So what will happen? For the first 10 lakh rupees, it is 1 lakh 10,000. You are at the age of 69. So therefore, it is 1 lakh 10,000 for the first 10 lakh rupees. Balance is 8 lakh 688 at the rate of 30%. Yes, number 240 206. Total comes to 3 lakh 50,206. This is for your slab rates. Until here, matching for everyone. All the 3 people who gave me the different answers, matching. Which one did not match? Not match, no? See, the only happen scenario is when I give you a clarification saying the rent income is given. Okay, this is the case where I've given you the income directly. When I'm giving you the incomes directly, it simply means what? These are all computed. Okay. Never make an assumption on those lines. Never make an assumption on those lines. The question will very clearly come and say this is the rent amount, or this is something where you have received so much in monthly rupees. Only in those scenarios will you do a reduction. Otherwise, you are not supposed to do a reduction unless and until the question very clearly clarifies that you are supposed to do it. Clear? Yes. When a question like this is given where they're asking you to compute the tax liability, the basic understanding itself is that your deductions are already taken care of. You have been given the final head of income. Okay. So with this, I think your answer is wrong. So which means which one is wrong for you? 9 lakh 19. Huh? Okay. 9 lakh 19 is out of the picture. Balance. Balance. How much do you have? You have 30% on this. So 1 lakh 50,000. 45,000. Then 1 lakh will be reduced. So balance 1 lakh at the rate of 10%. Therefore 10,000. 9 lakh 1,332 into 20%. 180 266. Keep the 332. Keep the 332. You cannot reduce it. Okay. 266. Last one is 2 lakh 80,000 into 60% first. First 60% number is 168,000. Add 25% on that. 2 lakh 10,000. Match that for everyone. 2 lakh 10,000. Women at the last match now. What did not match? What did you go? You forgot to add the surcharge. Okay, fine. Yes, this is what your tax liability will look like, including surcharge. Why are we including surcharge only for unexplained income? because the provision very clearly says you mandatory have to do a surcharge of 25%. Balance incomes, you have to check the slab model. Slab model says it is less than 50 lakhs, therefore no surcharge will come into picture. So all the three together along with this, yes, all the items together along with this, you will get a total tax. Add on that 4% says technically your number should come as 9 lakh 83 to 90. If it did not match for someone, check it again. Otherwise, people who have not done it, something is wrong. People who have not even practiced it until from yesterday to today, something is wrong. Some attempt is going to go for a shift. Please make that seriousness happening. Okay. So the answer is 9,83,290. Next one. I think question number 5 we did. Yes, sir. Nothing else to practice. Did I ask you to do question number 2, answer and also come? I told you the tax is not being computed. We only gave the understanding. Tax is something which you have to compute. Okay. Just for a practice sake, please do compute the taxes from your end also. Okay. Yes. Having said that, just a clarification before I start the class. Guys, those who are on broadcast, if you have not received the message from me even now, the reason is because you have not added me in your contacts. Okay. That is what I understood from YouTube yesterday apparently. That if you do not add my number as your contact, then the broadcast message will not be sent to you. Okay. I need to add you as a contact. You need to add me as a contact. Mutual relationship. Okay, so if you have not added me as a contact, please do add me as a contact. Some people have been messaging me on my personal numbers. That is not the number which is on broadcast. If you don't know what my number is, this is my number. Okay, this is my number. Please do add this to your contacts. Only if you add it to your contacts. See, I have added everyone as broadcast. Okay, so if the only reason you're not receiving my message is because you have not added me back, in that scenario only you'll not receive messages. Okay, this is the only number which I have for class purposes. Some people have been messaging me on the direct messages, my personal numbers. I don't know who's been giving you my numbers, but anyways, otherwise, I know for you, Ramana is the culprit here. Ramana, some person. Yes, I have been given my visiting cards, my office visiting cards, which they are calling me. I don't know what. Anyway. Yes, this is the only number which is there for official purposes. Please add this to your contacts. The moment you add these contacts, you will ensure that all the broadcast messages are received to you. If you still don't receive it after that, then you message me. Okay, clear? Yes, having that note, let's start with the next part of the chapter. We have completed with chapter number 1 and completed with chapter number 2. We are directly taking a shift and going to the second chapter in my book. Second chapter, not last second. Should be third last chapter. Talks about unexplained income. Okay, so let's take a shift and go back to your unexplained income just to quickly understand what the section looks like. Can someone help me with the page number? Okay, while this useless thing loads, I will complete it by then itself. Yes, we are into the chapter called as unexplained income. Hey, for YouTube people, it's not showing on the screen and all. Look at your book, that's all. Okay, we are in the chapter called as unexplained income. The logic is very simple of this chapter. It came and said that, boss, if you treat something as illegal, I'm going to ask an additional tax from you. The tax will not be the same as the slab rate or the 30%. I'm going to levy an extra tax on you at the rate of 60% with a mandatory surcharge of 25 and a mandatory cess of 4%. Effectively becomes 78. So then the question which comes is, what do you mean by illegal income? Income tax comes and clarifies, boss, it is illegal if assessing officer is not happy with it. What? It is illegal as long as assessing officer is not happy with it. In simple terms, what is happening is, assessing officer will come and ask you for an income. And ask you to check its validity. Meaning, they will come and ask you to tell, where is the source of this? They will ask you the source of this. You have two options. Explain the source, good enough. You explain the source, good enough. He will let it go. He will say, okay, boss, normal income, please tax it at a normal rate. Option number 2. You do not explain the source. Assessing officer will come and say, you were not able to explain the source. My understanding is this is unexplained income or illegal income. My understanding is it is unexplained income or illegal income. I will take that full income, directly tax it at the rate of 78%. Without allowing any kind of expense. That is the standard rule. Yes. Question to you. You are not allowing any kind of expense. Can you allow any kind of losses? Can you set up losses? No. Can you claim chapter 6A? No. Can you claim rebate? Yes or no? It will come in the middle only somewhere. Yes, you can claim rebate. You can claim rebate. You can be a poor illegal person. You can be a poor illegal person. You will be eligible for rebate. What you'll not be eligible is for set off of losses, any kind of expenses, any kind of chapter 6. Yes, sir. Yes, sir. That is what the concept is when it comes to unexplained income. They have additionally put a second condition. They've additionally put a second condition. In the second condition, they came and said, no, boss, there could be a way where I can explain the source. There could be a way where I can explain the source, but it could so happen that the assessing officer is not happy with it. Assessing officer is not happy with it. A simple example to you. Let's say you are going for a wedding. You're going for a wedding. You suddenly saw the big premises of the wedding. They've done a lavish wedding. Ranveer Singh and all is coming and dancing in that wedding. Okay, they've spent hundreds of crores of money on that. Okay, you somewhere had a doubt. This guy yesterday did not have money to pay me back also. And suddenly Ranveer Singh and all is coming and dancing in his wedding. Something is wrong. What did you do? You went and complained to his assessing officer. You went and complained to his assessing officer, sir, he spent too much money on his wedding, whereas he did not have money to repay my loan also. Please go and check his source. What will that guy do? He went and he checked with your friends, boss, tell me where is the source of this wedding money? Where is the source of this wedding money? Your friend came and said, sir, my dad sponsored. What? So what he will come and say? Okay, tell me the income of your dad. Tell me the income of your dad. In this scenario, have you explained the source? Have you explained the source? Yes. In this scenario, can you go and tell assessing officer, sir, I explained my source. Don't tax me. No. What he will do? He will go and verify your dad's income. He will go and verify your dad's income. It so found out that the wedding expenses were about 5 crores. Wedding expenses were 5 crores. Your dad at any given point of time is only 50 lakh rupees per year. How much? 50 lakh rupees every year. Meaning, how many years does he have to work for getting that kind of 5 crores worth of income? 10 years. He has to work for 10 years. In that 10 years, even if he works and only has this income, only can he have 5 crores. But he's a working person. There is a wife at home, brother at home, sister at home, education cost and all. Let's say approximately 60% goes into it. Approximately 60% goes into it. Meaning 50 lakhs worth of income, 60% gone. 30 lakhs gone. 20 lakhs is what he had savings. Yes or no? Now 20 lakhs into last 10 years, how much? Which means he has a justification for 2 crores. Balance 3 crores. Justification irka ilya? In this scenario, assessing officer came and said, boss, 2 options. Option number 1, I ask you source, you don't even have the reason. In that scenario, it will become unexplained. Option number 2, they're coming and saying, no, boss, you explained the source, but I am not happy. Now, he's not happy for what income? 3 crores. He's not happy for 3 crores. In this scenario, unexplained income is 2 crores, 3 crores, 5 crores, none of the above. 2 crores, 5 crores, 3 crores, none of the above. 3 crores. It is 3 crores. He got a justification for 2 crores. Yes or no? He got a justification for 2 crores. He's happy with that 2 crores. So will he tax that 2 crores? No. What he will tax? 3 crores. This 3 crores will be taxable at the rate of. Question to you. This 3 crores was it income or expense? Income or expense? அப்போ எப்படி expense tax பண்றீங்க? நான் பாட்டுக்கு ஏதோ சொல்றேன் நீங்க பாட்டுக்கு ஒத்துக்கிறீங்க. Very good. There is a special provision when it comes to unexplained income. In that provision, they come and say, boss, even if you have incurred an expense and you're not able to justify the source of that expense, I will assume that the expense would have come from some income which is unexplained. I would assume that the expense is coming from an income which is unexplained. So I will come and tax this expense as an unexplained income. What am I doing? I'm taxing the expense as an unexplained income. Permitted, perfectly permitted. In which scenario, what will happen? The 3 crores will now become an unexplained income, taxable at the rate of 78%. Yes or no? Can the father come and say, sir, you want to tax this income tax, but technically I also paid this money. Revenue expense 0, knock off. Therefore, tax 0. Solla mudiyama? Mudiyada? Yes, understand, unexplained expense also becomes an income, but the expense is disallowed. Which means what will be taxed is 3 crore rupees at the rate of 78, flat gone. You cannot come and take a You cannot take a justification on that lines, come and say that, sir, no, I do not want tax on it because it's an actual expense for me. That will also be taxed. Clear? Yes, keeping that in mind, let's quickly go through our unexplained incomes. I am not showing it on the screen. Let's read your book. Okay. The first item, if my memory serves right, talks about unexplained investments. Cash credits. It talks about unexplained cash credits where they're coming and saying, boss, if you have any kind of cash in hand, please explain me the source. Two options. Either you don't explain the source or you explain, but it is not satisfactory to myself, assessing officer. This cash credit will be treated as an income. Will be taxed at the rate of 78%. Option number 2. Unexplained investments. You saw your financials. In the financials, you found one investment. They asked you for the source. You were not able to explain the source. What will happen? Unexplained income. The investment will become an income. Option number 3. Unexplained. Same scenario. Same as one. What has happened? You have received money in hand. Money ka source illa, that they will come and tax it. Point number 4. Partial disclosure. What is happening is you basically have a balance sheet. You opened up the asset side of the balance sheet. You found one chappal rupees 10. You found a chappal rupees 10. Asset or not asset? Asset is worth 10 rupees. You went and you checked the chappal from Jayalalitha's house. You found the chappal has diamonds on it. Real life story. These characters are purely real and with no fictional nature on it. Okay, ulta. Okay, the chappal has purely diamonds on it. Chappal is worth 10 rupees in the assets, but chappal actual worth is more than 2 crores. You will go to the assessee and come and say, sir, your asset worth is actually 2 crores, but your chappal worth is showing only 10 rupees. Where is the difference? Assessing officer assessee 2 options. Either explain the source and assessing officer became satisfactory, or don't explain the source. What will happen? It will become taxable. What is the number to be taxed? I gave you the example, no? 1,99,99,990. This will become taxable at the rate of 78. Clear? Not clear? Yes. Next point. Unexplained expenditure is what I gave an example for wedding season. Next. Amount borrowed and repaid on hundi. For those people who are thinking hundi means Tirupati, no. Okay, it's not the Tirupati hundi. Hundi here basically means illegal money. We call it as hawala transactions. Money laundering. You would have seen that Shivaji the boss scenario. Yes, the whole Shivaji the boss scenario is nothing but your hundi. You come sit here. From here you are giving Indian rupees. There you are going and collecting US dollars. That note which he gave, no, that special currency note is nothing but your hundi. And the special currency note you got the US dollars. So that special currency note is called as hundi. Income tax comes and says, boss, any kind of transaction of hundi, straightforward treated as illegal. Unless and until you explain me what is the reason. If you are able to justify this is legal, then only it will be leave. Illana, it will mandatory be taxed. Understand the difference between this and the other one. In the above scenarios, what was happening? Assessing officer will come and ask you that it is illegal, so you explain me the source. In which scenario, what is happening? You explain it is legal, it is over. In this scenario, it is deemed that it is illegal. You need to prove that it is legal. The scenario is different. Okay. There you are given an opportunity. Here you are told you have given a reverse opportunity. It is directly treated as legal, but you need to justify it is legal. Here it is treated as illegal and you need to justify it as legal. Other than difference. Clear? Yes. Any doubts in this chapter? No. These are your 5 scenarios. Is this coming in exam? No. It's not coming in exam. The only way it is going to come in exam is you need to straightforward look at the question. Question will come and say, assessing officer asked for a reason. The reason was not satisfactory or the reason was not justified. What will you do? You don't have to learn it for exam. This is what you have to read for the chapter. In the chapter, in the investment expenditure income one straightforward. Question assessing officer asked for a reason. Reason was not satisfactory. Treated as See the question. The assessing officer, during the course of assessment of an individual, found that it had paid rent in respect of its business premises amounting to 60,000, which was not debited to the P&L account. He paid a rent of 60,000 rupees, did not debit it to P&L account. The individual did not explain the source of payment of rent. Did not explain the source. This is The assessing officer is proposing to make the addition of 60,000 in the hands of individual. Correct idea? Correct idea? He has proposed to add the 60,000 as an income in the hands of individual. Correct or not? Correct. The individual claims that even if the addition is made, the sum of 60,000 should be allowed as deduction while computing the business income. Is the assessing officer right or the individual is right? What will you do in the scenario? Tax the 60,000 at the rate of 78%. Expense will become ignored. Expense will become ignored. Yes or no? Yes, clear? Yes. Done. With this, we are done with chapter number. Chapter adu? Number ketama. Take it off and close it. Done with chapter number 1, chapter number 2, and chapter number 22. Chapter number 25, I think I've already told you it is out of syllabus. 25 or 24 are they? 24. 24 is out of syllabus. Done with 4 chapters by now. Okay, 4 chapter. Yes, coming to the next chapter, we are into the chapter called as residential status and scope of total income. This is basically your golden rule number. Basically, your golden rule number 2 and 3. And 3, your golden rule number 2 and 3. We are into the chapter called as residential status and scope of total income. What this chapter basically comes and says is, boss, I need to first understand who are you. I need to first understand who are you, because if you are a resident, the scenario is different. If you are a non-resident, the scenario is different. Why? When you are a non-resident, I'm only going to tax your. I'm only going to tax 4 sources of income. I'm only going to tax 4 sources of income. If you are an R and OR, I will tax Indian income. Understand the difference. Understand the difference. Indian income means 5 sources. Foreign income non-resident only 4 sources are taxable. So it is 5 sources will become Indian income, and for resident it becomes global income. Resident it becomes global income, which is where it becomes extremely important for you to understand what is your residential status. Yes, residential status works in the same way as taxes. So we have to now differentiate between our persons. Let's differentiate between our persons. The only important person for your exam purposes is individual. The only important person is individual. For those who have been in my classes, you know we follow a chart format. We follow a chart format. For those who have not been there, you will find a chart in my book. I think it's page number 15. It's page number 15. The whole residential status of individual is summarized into this chart. The whole residential status of individual is summarized into this chart. If you can follow this chart, your chapter is over. That's all. Okay. This is the only chart we need to follow. Not required. Completely not required. You can ignore the whole story and come. We're going to follow the chart and let's work with that. What is going to happen is, as a part of your residential status of individual, first thing you need to understand is it is dynamic or static. Is residential status dynamic or static? It's dynamic, which means today you are a resident, tomorrow you could become possible, not possible. First rule is to understand that you can have a resident status to be dynamic in nature. Keeping that in mind, if I am coming and asking you the residential status and you are able to find out what is the residential status, it will only apply for your attempt, yes or no? Next attempt, the facts could be different. Yes, keeping that in mind, let's work with this. We are going to understand what is the resident status of the current year. Resident status of the current year. Current year meaning? Adama, for your exam, current year is 22, 23. Your current year is 22, 23. This is one mind. Attempt. Yes, your current year is previous year 22, 23. Assessment year is 23, 24. For previous year 22, 23, we need to understand what is your residential status. The first and the most primary condition which an individual they say is, boss, you need to stay in India for 182 days. 182 days in the previous year assessment year. In the previous year. Yes, first and the most primary condition in a book is that you have to start for 182 days in your previous year. On the top, very top. On the very top. It's ulta, but you take it. Okay. It's called as 182 days in the previous year. Let's say you satisfy the condition. You will directly become a resident. In my chart, it will go to the right side. In my chart, it will go to the right side. Let's say you don't satisfy the 182 days. Will you directly become non-resident? You will not directly become a non-resident. We will check for certain conditions. Condition number 1. Are you an individual who is going outside India for employment? Yes or no? If you say yes, I will directly treat you as a non-resident. The reason is very simple. book comes and says that if you are an individual going outside India for employment, condition number 2 is ignored. If condition number 2 is ignored and condition number 1 says that you should stay for 182 days, you did not stay for 182 days, condition number 2 ignored, therefore you directly become resident. Yes or no? So first criteria, check for 182 days. If satisfied, go to the right side. Not satisfied, come to the left side. In the left side, I will come and ask you one question. Are you an individual leaving India for employment? You say yes, I will say non-resident. You say no, hold. Question number 2. Are you a crew member of an Indian ship? Are you a crew member of an Indian ship? If you are a crew member of an Indian ship, are you leaving India? Are you leaving India? If you are a crew member of an Indian ship leaving India, condition number 2 becomes ignored. Meaning again what will happen? You will become a non-resident. You will again become a non-resident. Yes or no? 2 conditions for you. Condition number 1 is where you are leaving India for employment. Condition number 2 is where you are a crew member of an Indian ship leaving India. Suppose you are none of the two. Suppose you are none of the two. You will now wait. Still wait on the left side. Still wait on the left side. I will come and ask you one question. Boss, are you an Indian citizen or a person of Indian origin? What are you? Indian citizen or a person of Indian origin. Which means I need to first understand what do you mean by a Indian citizen? What do I mean by a person of Indian origin? Income tax comes and says Indian citizen means you are a citizen of India. What? Indian citizen means you are a citizen of India. There is an act called Citizenship Act. There is an act called Citizenship Act. If that act recognizes you as an Indian citizen, you are an Indian citizen. If that recognizes you as an Indian citizen, you are an Indian citizen. Rahul, what are the criteria for you to become an Indian citizen? Not required. Not required. Exam will come and very clearly come and say it is an Indian citizen. You work with that. That's all. Okay. Exam will very clearly come and say you are an Indian citizen. Let's stick to that. What is the criteria and all is not required. It's not required. Second is what is a person of Indian origin? What is a person of Indian origin? Income tax comes and says, boss, if your parents or your grandparents were born in undivided India, you will be called as a person of Indian origin. What the hell is this undivided India? The states which were in India before, the countries which were in India before independence. Examples are Pakistan, Afghanistan, Sri Lanka, Myanmar, Bangladesh, Bhutan. Yes, sir. All these states. If you are a part of these states, then you will be called as a person of Indian origin. Coming back to the chart, I asked you, are you an Indian citizen or a person of Indian origin? If you say yes, I will come and ask you a simple question, boss. I will ask you a simple question. What is your Indian income? If you tell me my Indian income is less than 15 lakhs, I will say condition number 2 ignored. Directly non-resident. If you say no, my Indian income is more than 15 lakhs. I will ask you, are you coming to India for a visit? Meaning, you have come as a tourist. Are you coming to India for a visit? If you say yes, I have come to India for a visit and my Indian income is more than 15 lakh rupees, I will ask you one question. But in condition number 2, are you staying in India for at least 120 days? Which year? In the previous year. Meaning you should stay in India for 122. By 181, no? If it was 182, you would already gone to the right side, correct or not? Which means the only thing you can be is up to 181. So I'm asking you a simple question. Are you staying in India for 120 to 181 days? If you say yes, I will ask you question number 2. Do you stay in India for 365 days in the last 4 years? For your exam, what is the last 4 years? First, what is your year? 22, 23. What is the last 4 years? 21, 22, 20, 21, 19, 20, 18. Yes or no? I will ask you, if you have stayed for more than 120 days and less than 181 days, have you also stayed for 365 days in the last 4 years? Is this and condition or condition? And condition. Rendume satisfy agano. If you satisfy both the conditions, you will directly become an RNOR. What are you now? RNOR. I'm not checking ROR, RNOR out. Directly RNOR. You say, no, Rahul, although my Indian income is more than 15 lakhs, I have not come to India for visit. I have not come to India for visit. I will say, okay, boss, hold. Option number 2, I say, no, I am not even an Indian citizen, not even a person of Indian origin, meaning now you are foreign citizen. Now you are foreign citizen. I will do one thing, I will club both. I will club both. What are club both? Foreign citizen, people who have not come to India for visit. People who have not come to India for visit. Club both. Club both. In these two scenarios, you will come and say, boss, have you stayed in India for 60 days? Less than 182 days. Less than 182 days. Have you stayed in India for at least 60 days in the current year? And 365 in the last 4 years. In last 4 years. You say yes. I will say you are resident. I will say you are resident. I will not get into ROR, RNOR and all. I will say you are a resident. You say no, you will become non-resident. You will become non-resident. Now you are a resident. Now you are a resident. If you recall in the chart itself, we went to the right side and we said you are only a resident. Take that resident, take this resident, merge together. Take both the residents, merge together. Ask him 2 questions. Ask him 2 questions. Question number 1. Where you were resident for at least 9 out of 10 years. At least 9 out of 10 years. 10 which years? Preceding previous years. 9 out of 10 preceding previous years. Or have you stayed in India for less than 730 days in last 7 years? Or condition, air condition. Or condition and condition. Or condition. Or condition. Or condition. Have you been a non-resident for 9 out of 10 years or have you stayed in India for less than 730 days? I will ask you that question. You say yes of any of the 2. You say yes to any of the 2. I will make you R and OR. I will make you R and OR. You say no to both, you will be called as ROR. You will be called as ROR. Clear? Clear? Here is where comes an exception. In an exception, they come and say, boss, if you were non-residents anywhere, if you were non-resident anywhere and your Indian income was more than 15 lakhs, your Indian income was more than 15 lakhs, I will come and ask you where you were resident in any other country. Where you were resident in any other country. You say, no, Rahul, I am having Indian income more than 15 lakhs, but I am not a resident anywhere. I am doing monkey business, jumping from one country to another. Jumping from one country to another. At the end of the day, who are you? You are an Indian citizen. You are an Indian citizen. As an Indian citizen, if your Indian income is more than 15 lakhs and you are not a resident in any country, you're not a resident in any country because you're not liable to pay tax in any country. Our government says, boss, I will give you shelter. You become my resident. You become my resident. Someone has to catch your neck. No, I will do that favor. So I will come and catch your neck. You will be called as a deemed resident. You will be called as a deemed resident. And your residential status is nothing but RNOR. Your resident status is nothing but RN. Meaning what is taxable for you? Indian income is taxable for you. Indian income is taxable for you. Clear till now? Yes. Let's quickly understand the chart once again. Yes. Everyone together. First, most basic condition is you have to stay in India for 182 days. If you are staying in India for less than 180 days, you will come to the left side. In the left side, you will come and ask yourself, are you in employment going outside India? If yes, you are non-resident. If you are a crew member of Indian ship going outside India, then yes, you are non-resident. If you are an Indian citizen or a person of Indian origin, ask yourself if you are staying in India for a visit or are you not coming for a visit. If you are coming in India for a visit, I will ask you if you are having an Indian income more than, if you say your Indian income is more than 15 lakhs, I will tell, check whether your stay in India is more than 120 days. Check whether your stay in India is more than 120 days and 365 in the last 4 years. If you say yes, it becomes RNOR. You say no, it becomes non-resident. You say no, it becomes non-resident. You say no, Rahul, my Indian income is less than 15 lakhs. You are directly non-resident. You are directly non-resident. No, you have not come to India for a visit or you are a foreign citizen. Or you are a foreign citizen. You need to check whether your stay in India in the current year is 60 days and 365 in the last 4. Satisfy the condition you are resident. Satisfy the condition you are resident. Don't satisfy the condition you are non-resident. Now you have a resident here, you have a resident on the right side. You have a resident on the right side. Merge both and check for conditions, 3 conditions. 2 conditions. Check for 2 conditions and or conditions. Non-resident should be less than Non-resident should be staying for less than 730 days. Should be staying for less than 730 days in the last 7 years and should be a non-resident for 9 out of 10. Satisfy any one of the condition, you will become RNOR. Don't satisfy the condition, you will become ROR. But if you are a non-resident anywhere and you are an Indian citizen, I will check for your Indian income. If your Indian income is more than 15 lakhs and I find out that you are not liable to pay tax in any other country, you will become deemed resident of India. Your residential status will be called as clear, not clear. Clear. Yes, 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 yes. In this, two rules for you. Rule number one: if you are a crew member person, the day you board the ship, and the day you come out of the ship, that full period will be called as outside India. The full period will be called as outside India. The day you board the ship and the day you come out of the ship, the full period will be called as outside India. Full period will be called as outside India. But yes, the day you leave from India, will be deemed as India. The day you come to India will be deemed as India. The date of arrival and the date of departure are both considered as a part of stay in India. Only one exception: crew member. Only one exception is crew member. Crew member, the day when he signs itself, that day itself he will become outside India. And when he comes back, that day also he will become outside India. Clear? Yes. Yes. This is what your conditions are when it comes to an individual. These are what the conditions are when it comes to an individual. Any doubts to know? All clear? Yes. For your exams, it's enough if you read the chart and go. The chart will itself help you out. If you still feel you want to read the theory, your choice. Okay. But the chart is what I've prepared. If you can remember the chart in a proper sequence, the image flows in your head, the answer will automatically come. Okay. So understand it is right side one chart, left side there are three charts. Keep that in mind. We will do our sums basis that only. Okay. With this, your resident status of individual is done. Coming to the next resident status called as HUF. HUF works on a model of C and M. Control and management. It works on the model of control and management. They basically come and say, boss, if your control and management is wholly or partly in India, you will be called as resident. If you say, no, boss, your control and management is wholly outside India, you will be called as non-resident. Who will be called as non-resident? Who will be called as non-resident? HUF. We are still discussing about the HUF. Sudden or Google put up. Yes, we are still discussing on the HUF. If the HUF's control and management is in wholly outside India, it is called a non-resident. If it is partly or wholly in India, it is called as resident. In this scenario, we have to split the HUF into ROR and RNOR. How do we split? Take the two conditions. NR becoming 9 out of 10 or stay for less than 730 days. You need to check these conditions for the Karta of the family. If the Karta of the family was a non-resident for 9 out of 10 years, or the Karta of the family was staying for less than 730 days, you will be deemed as a... Who will be deemed as a non-resident? Who will be deemed as a non-resident? HUF will be deemed as a non-resident. Karta order status is independently checked by the chart format. I'm only bothered about the HUF. Clear? Yes. See this table and help me understand. How it works. Okay. You are in case number 1. The HUF's C and M is given as foreign. The residential status of the HUF will be non-resident. Look at the Karta. Karta has stayed in the current year for 200 days and in the last 7 years for 185 days. Karta is a first to go on the right side because he's gone more than 182. Therefore, you are a resident. Come to the right side, it comes and says, boss, you have been in India every year for 185, which means every year you are a resident, which means condition number 1 not satisfied. What condition? You should be non-resident for 9 out of 10. Here, every year you are going to be resident. Therefore, first condition not satisfied. Multiply 185 into 7. It is going to 1000, which means 730 also not satisfied. Meaning now this person will become R. Yes or no? Case number 2. Your HUF is foreign, meaning Your Karta in the current year has stayed for 200, but in the last 7 years has only stayed for 100 days. Which means in the last 7 years, you only stayed for 700. You were supposed to stay minimum for. You did not stay for 730. You will now become R NOR. Yes or no? Case number 3. Your HUF is foreign still. Your Karta in the current year has only stayed for 59 days. Do you want to check for the last 7 years? No, why? Bare minimum he should have stayed for 60. Bare minimum he should have stayed for 60. He has stayed only for 59. That means he is now a. Case number 4. Karta, sorry, HUF is still in foreign. Kara? Yes. Case number 5. Your HUF is in India. You are right now R. I don't know what are. I don't know what are. Let's come to Karta. Let's come to Karta. Karta in the current year has stayed for 200 days and the last 7 years has stayed for 185 days. Karta is, the moment Karta is ROR, HF becomes ROR. Yes or no? HF becomes ROR. Come into the next one. Karta is, sorry, HF is still in India. R. Come to Karta. Karta in the current year is for 200 days, but in the last 7 years is only for 100 days. Karta is now, which, if Karta becomes RNOR, HF becomes RNOR. Yes or no? Now let's the next scenario. Your India HUF, therefore it becomes R. Karta in the current year is for 59 days. Karta becomes NR. Yes or no? Karta becomes NR. Now what to do for HUF? What to do for HUF? If Karta is NR, HUF should become NR, correct? Huh? If Karta is NR, HUF should become NR, no? No. 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 Understand, my criteria to check for a Karta, sorry, for the HUF is basis the NR's last years. It is not current year, it is last years. Last years he was there for 185 days each, which means assuming the Karta would have been resident in the current year, he would have been ROR. Because of that, HUF becomes Purida. Anyone, do I have to repeat? No? Clear? Yes. Understand, if the Karta, if the HUF is becoming a resident, Karta will be a non-resident, it doesn't matter. But you just have to check for the last years, not the current year, not the current years. Last year's Vechita Pata, he is an ROR, therefore Karta HUF becomes ROR. Clear? Come to the last scenario. Your HUF is in India, therefore it is. Your Karta, your HUF is in India, therefore it becomes resident. Your Karta is in current year for 59 days, therefore he is NR, which means HUF becomes NR. HUF becomes NR. No. Check for what will happen if Karta was a resident. If Karta was a resident, last 7 years he was there for 100 days, meaning he would have been RNOR. If he was going to be RNOR, HUF will become. Yes? Clear to now? Yes, perfect. With the HUF getting over, now we have something called as AOP, BOI, firm, AJP. AOP, BOI, firm, AJP. Now, merge panna, they are coming and saying straightforward case first, copy paste of HUF. Straightforward case, copy paste of HUF. The only difference is on the RNOR and ROR will not happen. ROR and RNOR will not happen. Meaning, if your C&M is wholly or partly in India, you are resident. If it is wholly outside India, you are. That is all the criteria. Clear? Last scenario for your resident status is talking about a company. Talking about a company. They came and said, boss, simple. If you are an Indian company, you are resident. What are you? What are you? You are an Indian company, you are a resident. What the hell is an Indian company? Very good. Any company which is registered under Indian Companies Act will become Indian company. Will become Indian company. If you are registered under Daman and Diu, Jammu and Kashmir, all these union territories, also you are a Indian company. As long as you are registered in India, you will be called as an Indian company, and as long as you are an Indian company, you will always be a resident. You will always be a resident. You will always be a resident. Then they came and said, boss, if you are not an Indian company, what are you not? If you are not an Indian company, check for your poem. Check for poem. What is poem? Check for a poem. If the poem is in India, it becomes a resident. If the poem is outside India, it becomes non-resident. It becomes non-resident. Question to you. HUFLA we used wholly or partly in India. HUFLA we used wholly or partly in India. Here we are saying poem in India. That's all. Why is there wholly or partly not used? My cat, my mew. Yes, the answer lies in the poem. The word itself used is effective management, meaning they have itself already criteriaed into effectiveness. They've already criteriaed into effectiveness. What you are not checking is wholesome management. You are checking for an effective management. If effectively you are in India, that means you are a resident. If effectively also you are not in India, you are a indirectly they covered it by using the word poem. And not poem. Poem and not poem because he is missing. Yes, if you use the word poem, it is only India. It is not wholly or partly. The reason I'm telling you this is because exam la poite poem is wholly or partly anything na. Can't. Okay. Yes, poem is only in India. Giving this scenario, we need to understand that we have used a new word called as Indian company. Whereas until rates of taxes, we were using the word domestic company and foreign company. Pudusa or vaartha vanduchu. Correct? So we need to now figure out what the hell is this domestic company and what the hell is the foreign company. Income tax comes and says domestic company means any company which is Indian company. And also a company which is distributing dividends in India. What? Distributing dividends in India. Which means if you are a domestic company, you can be two kinds of companies. Company number one is an Indian company. Company number two is your distributing dividend company. You can be two kinds of company. Question to you. If you are an Indian company, RS is, what is RS? Residential status. RS is fully resident. If you are a dividend distributing company, RS is domestic na Indian company. What is the difference between both of them? A domestic company means a company which is an Indian company or a company which is distributing dividends. Both are two different companies. Indian company is always a resident because of RS. What happens to the other side of the company? Check for poem, that's all. Check for poem. If the poem is in India, poem outside India. Yes or no? What is a foreign company, pa? What is a foreign company? What is a foreign company? Not registered under Companies Act. Look at this scenario. No dividend distributing company. Is that company registered under Companies Act? How is it a domestic company? Foreign company is a company which is not a domestic company. Hey, when you've already defined one set of company, why do you want to define the other set of company? Why make life complicated? Yes or no? What is a girl, not a boy? I mean, things have changed after a certain point of time, but yes, things have changed after a certain point of time. Ideally, the practice was what is a girl, not a boy. That's all. Yes, now things are very different. I'm not going to comment on that. But anyway, the point is very simple. What is a foreign company? You know what is a domestic company, which means whatever is not a domestic company becomes a foreign. It's all over. Yes or no? How do you check the RS of foreign company? Same. Poem. If it is India, resident. Not in India, non-resident. What are the tax rates? Domestic company, Indian company, resident. What is the tax rate? Slab. What is the slab rate? Say, what is the tax rate? It is either 25 or 30. Hey, turnover less than 400 crores, it will become 25. Turnover more than 25 crores, turnover more than 400 crores, it will become 30%. Yes or no? Yes, come to the right side. You are a dividend distributing company. POM is in India. You are a resident. Tax rate is same 25 and 30. You are a dividend distributing company. Your POM is outside India. You are non-resident. Tax rate is hold a discussion. I don't know. Hold a discussion. Okay. Right side. You are a foreign company. POM is in India. You are a resident. Tax rate is 40. Okay. You are a foreign company. POM is outside India. You are a non-resident. Tax rate is this. I will agree. You have two options. Tell me the tax rates. 40 for both of them. Foreign company, resident, 40. Dividend distributing company, POM outside India, non-resident. Your tax rate for a company is not determined based on your RS. It is determined based on your status. If you are a domestic company, it becomes 25 and 30. I don't care whether you are a resident, non-resident. Yes or no? I only care about what your status is. If your status is a domestic company, you are a 25 and 30% bracket. If your status is a foreign company, you are 40% always. You are 40% always. Even if you are a foreign company with a residential status of resident, it does not matter. You will still be considered as a 40% bracket. You will still be considered on your 40% bracket. Be extremely careful about these items. This is something which even final students make a mistake on. Okay, this is something which even final students make a mistake on. The moment they see something as non-resident, they'll say 40. The moment they see something as 20 residential status, they will say 25 and 30. Doesn't work like that. Doesn't work like that. Your residential status does not determine your tax rate when it comes to companies. It only affects when it comes to individuals. Yes or no? Right. If you are a resident with the age of 60 years, you will get 3 lakhs. But if you are a non-resident with the age of 60 years, you will be getting. The only place where it affects your tax rates is in individuals. Anywhere else, it will not affect your tax rates. Clear? Yes, I would have given it somewhere in my book. Irka. Go through. Clear? Yes. Yes. This marks the end of your first leg of the chapter. This marks the end of your first leg of the chapter, exactly 3 o'clock. Okay, we have completed it in exactly 55 minutes. Somewhere around 55 minutes. In 55 minutes, we're done with it. I have asked you 2 questions. You failed in answering. Adhanala time waste. Ilana, you could have completed it in easily 30 minutes. Yes, this is what your status of residential status looks like. Clear? Yes. Coming to the next leg of the question, we are into scope of total income. What is this basically coming and saying is, boss, if your residential status is a resident, you have a different scope. If you are having an RNOR, you have a different scope. If you have an NR, you have a different scope. So let's understand what happens. They basically come and say that if you are an ROR, what are you? ROR, your global income is taxable. Ni end income vechalo, every income is taxable. If you are an RNOR, what are you? You have 5 sources of income which are taxable. You have 5 sources of income which are taxable. In short form, we call them as Indian income. We call them as Indian income. What are those 5 sources of income? It is income received in India, income deemed to receive in India, income accruing or arising in India, income deemed to accrue or arise in India, then income accruing or arising outside India from a business in India. From a business in India. Income vandittu velila irukku, ana business is in India or a profession is set up from India. Okay, business in India meaning business is controlled from India. Business is controlled from India. Let's say you receive profits of your company which is in India, in Afghanistan. This will be classified as you have a company in India. You have a company in India. The profits of that are coming in Afghanistan. This is income. Very good. This is income accruing or arising in India. Understand business in India only. So this is directly accrued in India. I am discussing about the fact where the business is outside India. The business is outside India. Profit is also coming outside India, but the shareholders of that company are sitting here. What? Shareholders of the company are sitting here. I am not talking about business being in India. I am talking about business controlled from India. Understand the difference? The word controlled is important. The word controlled is important. The business should be controlled from India, meaning the shareholders or the directors should be sitting in. Clear? Yes. What is left off is your non-resident. Non-residents, they basically came and said, boss, income deemed to receive in India, income received in India, income accruing or arising in India, income deemed to accrue or arise in India. Nale items are taxable for you. Who are you? Non-resident. You are a non-resident. These are the kind of scope of total income which you have. Clear? Clear? At this point, let me clarify to you what is taxable for you is your income and not your receipt. What is taxable for you is your income, not your receipt. Meaning you have. What? I said receipt, not revenue. Okay. What I mean is you have a bank account in US. You have a bank account in US. You took the money in your bank account in US and then you moved the money to your bank account in India. You move the money from bank account of US to bank account of India. Is this income taxable in India? Hey, but it is received in India. You received it in India, no? What you received in India is not an income, but a receipt. What you received in India is not an income, but a receipt. Understand? All incomes are receipt, but not all receipts are income. Is the statement correct or ulta is correct? All incomes are receipt, but not all receipts are income. Is this statement correct or the ulta correct? This is correct. This is correct. Receipts is a bigger ambit. Receipts is a bigger ambit. Adukulla varada income. Adukulla varada income. Incomes are always receipt, but receipts are not always incomes. A classic case is you transferring your money from US to India is a receipt and not a income. Not an income. Clear? Not clear? Clear? Yes. Question number 2. You have received an income today. You have received an income today, but the accrual is going to happen tomorrow. The accrual is going to happen tomorrow. Will you come and say, boss, income received in India today, so tax it today. Income accrued in India tomorrow, so tax it tomorrow also. Why? Same logic. Today what you received is income, tomorrow what you received is receipt. Avladhan logic. Adedhan logic. Okay, you can only have income once, you cannot have income twice. Next time it becomes. Solve is the answer. Clear? Clear? Yes, yes. Let's clear the wind on those lines. Yes, yes. Let's understand this example. Tell me which one is taxable for what? I have 3 people. I have 3 people. One is called as ROR, RNOR, NR. Income received in India. Taxable for all 3. Income deemed to receive in India. All 3. Income accruing or arising in India. All 3. Income deemed to accrue or arise in India. All 3. Income accruing or arising in India. Income accruing or arising outside India from a business or profession controlled and set up in India. For ROR, taxable. For R and OR, taxable. For NR, very good. Your business or profession is controlled from outside India. ROR, taxable. R and OR, not taxable. NR, not taxable. Your income is from other heads accruing or arising outside India. I will tell you taxable. R and OR, not taxable. Understand, the 5th head which we discussed is only talking about business from India or profession from India. This is other sources. This is other sources becomes not taxable. NR. Last scenario. Income earned and received outside India, later remitted to India. Taxable for, I know NR not taxable, RNOR not taxable. ROR. Hey, not taxed earlier na kuduthirukala. It's not deemed to be. I don't care whether it was taxed earlier or not. The moment you bring it into India, it is merely a clear. Any doubts? No. With this getting over, we need to understand what our scope of total income looks like. You know what is income received in India. Kaila cost vanda, it is income received in India. What is income accruing arising in India? Businesses in India, you are sitting in India, the revenue is happening. Straightforward cases. In the exam, if you see something called as businesses in India, you are sitting in India, profits are coming outside India, it doesn't matter, income is accruing or arising in India. What is income deemed to occur in India? Salaries chapter. What is income deemed to receive in India? Salaries chapter not coming for exam purposes. Salaries is coming, this is not coming. Salaries is coming. Yes, the last wind to be blown is income deemed to accrue or arise in India. We have something called as Section 9. Section 9. In Section 9, they have come and clarified certain scenarios where income will be deemed to be received or accrued, deemed to be accruing or arising in India. Let's understand our 5 heads of income. What are the 5 heads of income? I have 5 heads of income for you. In this 5 heads of income tax comes and says, boss, if you are an employee of the central government, salary which you receive from that central government will always be taxable in India because it is deemed to accrue or arise in India. What is scenario number 1? Salary received by a central government employee. Will always be deemed to accrue or arise in India. This is the first. Salary of government. First scenario, salary of government will always be deemed to accrue or arise in India. Only one exception. Any kind of allowance and perk is exempt. Any kind of allowance or perk is exempt from taxes. Meaning the only thing which is going to be taxed for you is your basic salary. Clear? Yes. So any kind of salary received by a central government employee will become deemed to accrue or arise in India, will become fully taxable except for your allowance and purposes. Give me an example. Very good. Employees who are working in an Indian embassy in a foreign country. Will be paid by Indian government. Their income is everything accruing outside India only, but they have been deemed to be accruing in India. Scenario number 2. Salary received by Indian company employee. Salary received by an Indian company employee for services rendered in India. Hey, is the Indian company a condition given? Income from salaries arising from services rendered in India will be deemed to occur or arise in India. Okay. Salary received by an employee for services rendered in India. Here, yes. If you are rendering services in India, whether you are from a foreign company, Indian company, and all, I don't care. You will be deemed to accrue or arise in India. Clear? First leg completed. First set of income, which is nothing but your salary. Second leg is HP. Simple. If your HP is in India, it is deemed to accrue or arise in India. What? If your HP is in India, your salary, so the income is deemed to accrue or arise in India. Comes the PGBP part, biggest pain area. One is called as agency. The other is called as SCP. One is called as agency, the other is called as SCP. But agency is a very local term, no? So we use the word business connection. We use the word business connection. Simple terms, they are coming and saying, if you are a dependent agent, for whichever principal you are working, that non-residence income is accrued or arising in India. What are you? You are a dependent agent for whatever principal you are working. Avanoda ella business income is deemed to accrue or arise in India. Correct or not? Yes. Scenario number 1. If you are an independent agent, whatever is the income is not deemed to occur. It's simple as that's all is the story. Okay. The story is basically that if you are a dependent agent, whatever is the income earned by you in India for the non-resident will be deemed to accrue or arise in India. If you are an independent agent, whatever is the income will not be deemed to accrue or arise in India. For whom? For the principal or agent? Principal. For the principal. Agent is anyway in India only, so which means he's technically a resident, yes or no? I am talking about the principal. Okay. Meaning, if there is a principal sitting in US, appoints an agent in India, comes and says that agent, please sell 500 iPhones in India. Please sell 500 iPhones in India. This agent is going to sell 500 iPhones. Revenue of this will be for agent or principal? Principal. This 500 iPhones will become taxable in India for principal, provided he is dependent. Provided he is dependent agent. If he is not dependent agent, it will not be taxable. Yes or no? In simple English, or not in simple English, in income tax English, it comes and says, if you are a dependent agent, you have established a business connection in India. Who has established? Principal has established a business connection in India. If you are an independent agent, the principal has not established a business connection in India. If you establish a business connection in India, it is deemed to accrue or arise in India. If you don't establish a business connection, it is not deemed to accrue or arise in India. Yes or no? Yes or no? In your books, you will find a lot of stories. There is some mechanism happening. You are sourcing order, procuring orders, giving contracts, doing principal relationships. There is some agency happening, some non-resident doing. No stories required for exam. Exam portha varaikku 2 lines, that's all. Dependent in the business connection, taxable. Independent in the no business connection, not taxable. Munju poche kada. But do understand, what is taxable is not the agent income, but your principal's income. Clear? Yes. This is what you have to understand from a business perspective. Coming to the next scenario called as SEP. What do you mean by SEP? What do you mean? Full form. Significant economic presence is where income tax is coming and clarifying that the person has a huge business happening from India. Is having a huge business happening from India. SCP or a full form is nothing but significant economic presence. We have determined 2 scenarios where we will treat you as a significant economic person in India. One is where you are selling goods and services more than full form more than 2 crores. If you have a turnover of more than 2 crores from your business in India, you will be treated as a SCP in India. Question to you, where have you learned this number 2 crores? Splitting up. Split pandani? Very good. 2 crores. Okay. I asked, when I meant turnover. So turnover 2 crores, where have you learned? You have learned it under presumptive taxation. For a business presumptive taxation, turnover is link pani padchada varom. Okay, link pani padchada varom. What? 4480. 4480. Yes, presumptive taxations. Your presumptive taxations of 4480, business turnover should be more than 2 crores. Should be more than 2 crores. Sorry, less than 2 crores. Should be less than 2 crores. Then in that case, you can opt for presumptive taxation. Here, if you go for more than 2 crores, you'll be treated as a significant economic presence. Second scenario, they're telling boss, you're not doing turnover business and all. But you're just going and asking people. Basically, you're doing surveys. What are you doing? Survey. You're doing a survey. In that case, if you're going and impacting at least 3 lakh users in India, in that case, you'll be treated as a significant economic presence. You treat it as a significant economic presence. Turnover should be more than 2 crores or your users should be more than 3 lakhs. Satisfy any one of the condition, you'll be treated as a significant economic presence in India. Yes or no? Yes or no? Here is where I'll give you certain exceptions. Exception number 1, they have come and said, boss, I will only treat something as taxable in India provided it is from operations in India. If the operations itself are outside India, why will I tax here? Yes or no? Scenario number 1. Scenario number 2. If you are into any kind of news and views, what are you into? News and views. If you are collecting any kind of news and views and the news and views are going to be used for outside India, meaning? Huh? Meaning, let's say New York Times comes and says, boss, Mahendra Singh Dhoni has hit a century in India. Mahendra Singh Dhoni has hit a century in India. Adukkaga assessing officer cannot go to New York Times and come and say, unnoda paper lende 10% is coming from Dhoni's income, so therefore pay me tax in India. Not happening. Okay? They will basically come and say, boss, your news and views are happening outside India, therefore no collection of taxes in India. No collection of taxes in India. For people who have studied with me, you will know the example which we are discussing. Yeah, there is some big level example. Now we'll give it later. Right now, if you're having any kind of news and views happening outside India, that will not be taxable in India. Third scenario, if you are going any kind of cinema, what are you doing? Any kind of cinema. Any non-resident is coming to India and shooting cinema here will not be taxable for his income in India. Will not be taxable for his income in India. Fourth one, if you are purchasing something from outside India only for the purpose of export. Only for the purpose of export. Something came to India, you manufactured on it, you sold it back. Not taxable. Not taxable. Scenario number 5, they've come and said, if you are displaying any kind of diamonds, as an uncut product, display of uncut diamonds, what are you doing? Display. What are you doing? Display. If you display your uncut diamonds and you silently leave, not taxable. Meaning what should happen? You should come to India, show the diamond, tell him, sir, you call me when I'm in London, then only I'll give you the product. What? You should only display it here, tell him to call you in London, send from London, then only it is not taxable. If today itself you enter into the sale transaction, it becomes taxable. What are the 5 scenarios, people? Scenario number 1, operations are outside India. Hey, you are free to use your book, it is okay. Okay, at least repeat, that's all. Yes, what is the first thing? Operations are outside India. Scenario number 2, doing collection of news and views for outside India. Scenario number 3, coming to India for cinema. Scenario number 4, purchasing for the purpose of export. Scenario number 5, display of uncut and unassorted diamonds. Only display. Clear, not clear? Yes. What is the turnover for SCP? What is the number of users for SCP? When are you on business connection case? Dependent agent for a resident and non-resident. Dependent agent for a resident and non-resident. If he is anywhere resident, why are you talking? It is dependent. Basically, my question is, should the principal be resident or non-resident? You are a dependent agent for a non-resident. You're a dependent agent for a non-resident, in which case the non-resident's income will become taxable in. Clear. Next one. What is it? CG. CG, basically they're coming and saying, boss, if the asset is in India, then it is deemed to occur as in India. What is it? Asset is in India, it becomes deemed to accrue or arise in India. Clear? Yes. Next one. IFOS. In IFOS, they're coming and saying, boss, multiple items are there. First item is dividend. First item is dividends. Dividends, they're coming and saying, if the dividend is given by Indian company, it is deemed to occur or arise in India. What? Dividend is given by Indian company. Dividend is given by Indian company, not by domestic company. What is the difference? Dividend is given by Indian company, not by domestic company. Why have they used Indian company, not domestic company? Understand? I said domestic company means a company which is distributing dividends in India, which means income will be received in India. Yes or no? Yes or no? In domestic companies, you have 2 companies. One is Indian company. One is company distributing dividends in India. If you're anyway going to distribute dividends in India, income is anyway received in India. Yes or no? Adukku nee deeming fiction podnoma podu devaliya. Which means the only deeming fiction you'll put is for Logic people. Don't mug up things. It is not helping out. Okay. Okay. You have first scenario is dividends. If you're distributing dividends in India, then in that case it is deemed to accrue or arise in India. Scenario number 1. Scenario number 2, gift. Scenario number 2, gift. If you are giving a gift to a non-resident, and it is taxable under section 56, then it is deemed to accrue or arise in India. What is 56? IFOS charging section. What is section 56? IFOS charging section. Do you have to remember the section number, people? No, you don't have to remember. If it is taxable under IFOS, then it is taxable in section 9. Then it is taxable in section 9, which means if you are giving a gift to a non-resident, it becomes deemed to accrue or arise in India to the extent it is taxable under IFOS. The most important items are FTS, royalty, and interest. 3 of the most important things when it comes to scope of total income. I'll take some time, so bear with me. What are we into? We are into FTS, royalty, and interest. Interest meaning simple English. No? A consideration paid for a debt. Yes, you are showing interest in his debt, therefore you are paying interest. Consideration paid for a debt is called as an interest. What do you mean by royalty? Consideration paid for. Use a common word. Product. Laptop royalty could be. Use a common word. Consideration used for use of. Common word. Patents, trademarks, copyrights, everything is together called one thing. Very good, IP. It's called as IP. Any kind of consideration paid for use of IP. What is IP? Intellectual properties. Intellectual properties could be patents, trademarks, copyrights, secret process, technical know-how. Very good. Technical know-how. All these items together are called as IP. If you pay consideration for those items, it will be treated as a royalty. Last item is full form is fees for technical service, meaning consideration paid for it is consideration paid for technical, managerial, and consultancy. It is fees paid for technical, managerial, and consultancy. What do you mean technical? What do you mean consultancy? What do you managerial? I don't know. Income tax also does not know. Okay. ICI also does not know, which means it is not coming for exam. What is not coming? Definition is not coming. For exam. They will very apparently put it in the exam itself saying this is consultancy services. You will put it as FTS. That's all. What is consultancy? You don't have to bother. I don't have to bother. The exam will come and say this is technical or consultancy. You just have to take it and put it. Okay. The criteria actually happens on what is the taxability. What is the taxability? In all the 3 scenarios, they said, boss, you have to check from the payer side. Yes. Meaning the person who's paying. Because it is an income for the receiver. Check from the payer side. What will the payer do with it? Payers can be 3 people. One is government. One is a resident. The other is a non-resident. That's all. You can either be a government, you can either be a resident, you can either be a non-resident. Question to you. If a government is paying interest, will he use it for India or for foreign? Ideally, he will use it for India other than his pocket. Therefore, this should be deemed to accrue or arise in India. Yes or no? If an interest is paid by government, it is deemed to accrue or arise in India. If royalty is paid by government, it is deemed to accrue or arise in India. If FTS is paid by government, it is deemed to accrue or arise in India. Next, you are now a payer of resident. The resident is going to pay you royalty. What is resident going to do? Resident is going to pay you royalty. If a resident is going to pay you royalty, he is going to use the IP for India or for foreign? A resident is going to pay you royalty. Where is the resident? He's going to use the royalty for He's going to use the royalty for India. In this scenario, the income for the other person should be taxable in India, not taxable in India. Taxable. The use is important. The use is important. The resident is going to use it in India, therefore it should become taxable in India. So the understanding is it is deemed to accrue or arise in India. It is deemed to accrue or arise in India. But this person says, no, Rahul, I'm actually going to use for outside India. Who is this person? Resident. The resident comes and says, no, Rahul, I might be a resident, but I'm going to use it for outside India. In that case, do you want to tax it? Do you want to tax it? No. So there is an exception. The exception says, generally, if the payer is a resident, it is taxable in India. However, if it is proved that the resident is using for outside India, then it is not taxable in India. For whom? Payer or recipient? Recipient. For the recipient. Clear? Clear? Any doubts? Should I repeat? Should I repeat? No. Okay. Last scenario. You are in non-resident. You are a non-resident going to make a payment for royalty. You are going to use the IP for India, for foreign. For foreign. Which means, will it be taxable in India or not taxable in India? Generally, not taxable. Generally, not taxable. But yes, if the non-resident comes and says, no, Rahul, I'm going to use it for India, then it becomes. Okay. In simple terms, check to what the use is. Check to what the use is. If the use is by government, it is going to happen in India, therefore taxable. If the use is by resident, it is going to happen in India, therefore taxable. If the use is by a non-resident, the use is not going to happen in India, therefore not taxable. But if the non-resident says he is going to use it in India, it becomes taxable. It becomes taxable. Clear? Not clear? 100% clear? Yes. There is only one exception. There is only one exception. The exception is here. The exception is here. Here they are coming and saying, boss, if the non-resident is going to pay interest, if the non-resident is going to pay interest, it is taxable in India only if it is pertaining to a business or a profession. It's taxable only if it is for a business or profession. Simple example. Simple example. Let's say there is Matthew Hayden coming to India. Matthew Hayden is coming to India for an IPL match. For an IPL match. He comes to India, goes to one Kirana store and finds a shirt. Finds a shirt. Loves the shirt, wants to buy the shirt. Loves the shirt, wants to buy the shirt. Ana pocket le kaasilla. What happened? He went to his friend Chris Gale and he came and said, Chris Gale, you give me some money so that I can buy the shirt. Chris Gale said, Rahul, Matthew, if I'm giving you this money, I'm giving this as a loan. I'm giving this as a loan. He said, okay, whatever, I want to buy the shirt, you give me the loan. Now this person has paid him loan, which means he will give him back interest. So what happened? Chris Gale gave this guy 1 lakh rupees as loan. 1 lakh rupees as loan. On this 1 lakh rupees, he's going to charge 10% interest, meaning he will pay him back. He will pay him back 1 lakh 10,000. Question to you. Matthew Hayden, resident, non-resident? Chris Gale, resident, non-resident? Matthew Hayden is going to give 1.1 lakhs to Chris Gale. Income in this is 10,000. Income is 10,000. Question to you. Is this 10,000 taxable in India? Yes or no? Why? So, taxable, not taxable? Why? Very good. The loan which has been taken by Matthew Hayden is not for the purpose of a business or a profession. It is for an other source or a personal expenditure. Therefore, it is not taxable. Option number 2. Matthew Hayden comes and says, no, Chris Gale, I'm actually taking this loan for the purpose of creating an IPL franchise in India. He's going to do what? He's going to take this 1 lakh rupees loan, create an IPL franchise in India. He's going to build a new company called Matthew Chennai Raiders. Yes, Matthew Chennai Raiders is what he's going to create a new IPL franchise. Adhikaga he's taking the loan. Adhikaga he's taking the loan. Question to you. Taxable, not taxable? Why? It's clear, not clear? Clear? 100% clear? Yes, I'm changing the question. This was not interest, but this was royalty. What was it? Royalty. Matthew Hayden paid royalty to Chris Gale. Matthew Hayden paid royalty to Chris Gay for personal reasons. For personal reasons. Taxable in India, not taxable in India. Taxable in India, not taxable in India. Taxable in India. When it comes to royalty and FTS, business and profession is not the criteria. Business and profession is not the criteria. Any source of income is okay. Any source of income is okay. In that scenario, personal indalo okay, business indalo okay, everything is taxable. Interest mattum portha varaikum, it should only be business in India. Clear? Yes, I'll show you the chart so that you understand better. It will be there. The blues you see, no? In the blues, if you see what is happening, if it is a government, then it is fully deemed to accrue or arise in India. If it is a resident, it is always accruing, arising in India. Exception is the case where it is used for outside India. But whenever it comes to non-resident, there are two boxes. Non-resident, there are two boxes. This box covers your interest. That box covers your FTS and royalty. When it comes to interest, it is generally not taxable unless it is used for a business or profession in India. But when it comes to FTS or royalty, it is generally not taxable, but taxable if it is used for any reason in India. Any reason in India. Clear? Yes. Guys, just to clarify, I'm purposely not showing my book in the class. I'm teaching it to you. I'm not showing the book in the class because I understand you people are having your own materials. That is the only reason I'm not showing my book. So, let's work with that. My intention not is that I'm teaching in the class and taking it as a marathon. My intention is very simple. I don't want to show this book because it might confuse you. What material you have in your hand is your Bible. That's all. Okay, so let's work with that material. The reason I'm rushing up so much is because I want you to go home and read from your own material. I am here to only explain the logic and make you understand things and solve a certain sums. Okay, I do not want to rely my material on you. Okay, the moment I do that, what will happen? You will start having the thought that you want to skip your material and you want to use my material. A wrong choice at the last minute. Okay, if you have not even studied from your material, then you can use my material. And the material thodave illa. Apuna you start from my material, but if not, please do not change your material. Okay, adanalada I'm not showing my material and not putting so much focus on it. So only focus on what I'm teaching you. Okay, only focus on what I'm teaching you. Go home, read the chapter again from your material, my material, whatever it is. Solve the sums which are given as a homework. That is the only intent. Clear? Any doubts? This marks the end of your chapter number 2 also. This marks the end of your chapter number 3. This marks the end of your chapter number 3. But since it's crash course and not marathon, let me do some sums also for you. Okay, so let's do some sums. You help me out with what the answers is. Are you confident with the chapter right now? Let's with the confidence do some sums. Okay, the question first comes and says, Mr. Ram is an Indian citizen who has left India on 22nd September 2022 for the first time. To work as an officer of a company in Germany. For the first time to work as an officer in Germany. You are required to determine the residency status of Mr. Ram. You are required to determine the residency status of Mr. Ram. How do you start? Step number 1 to figure out whether you are going for more than 182 days or not. When did you leave India? 22nd September, which means from what period to what period were you in India? From 1st April 22 to 22nd or 21st? 22nd or 21st? 22nd. Date of departure is deemed to stay in India. 22nd September 22. Calculate and tell me the number of days. Total number of days comes as 179. With the total number of days coming as 179, have you satisfied condition number 1? With not satisfying condition number 1, will you come to left side, right side? Left side. Let's come to the left side. The question now comes and says, you are an officer of an company leaving India for employment purposes permanently. Condition number 2, to be checked, not to be checked. Not to be checked. Directly become. You can write it in your pages. Okay? Next. Mr. Dey is a non-resident. Mr. Dey is a non-resident. Mr. Dey is a non-resident who is residing in US since 1991. US 1991 US he has come back to India on 1st April 2021 for permanent settlement. You are required to find his resident status for assessment year 23-24. Why? How? More than which year? Which year, ma? In 22-23, his number of days is 365. His number of days is 365. You have come to the right side of the chart or the left side of the chart? Right side of the chart. With you coming to the right side of the chart, now you are a resident. I need to check for two conditions. Condition number one is you should be a non-resident for 9 out of 10 years. I don't know that condition. Let's go to the next condition. What is the next condition? You should stay in India for less than 730 days. You were in India for how many days in the last 7 years? You were there in India. (22-23) is your year or previous year? In the attempt to come exam, which year are you writing exam for? 20? Assessment year or previous year? Previous year is? Yes. Understand, people. What is your previous year? 22-23. 7 years will start before 22-23, which means before 22-23, you are only there in India from 1st April 21 to 31st March. Number of days is. Have you been in India for more than 730? Which means you have satisfied condition number 2. Now you are a. Be extremely careful of what the year is. அதனால ரிப்பீட் பண்ணிட்டே இருக்கேன். What is your previous year? What is your previous year? What is your previous year? டவுட்டா இருந்தா வீட்ல போயிட்டு ஒரு ஸ்டாம்பா போட்டுருங்க. இந்த அட்டெம்ப்ட் பாஸ் ஆயிட்டே ஆகணும். Yes. What is your previous year? 20? Clear? Second one answer is RN. Over. Next one. You are Mr. Bretley, an Australian cricket player who is visiting India for 100 days in every previous year. 100 days in every previous year. This has been his practice for the last 10 years. Last 10 years, he has been in India for every 100 days. You are required to find out his resident status for the current year first. What are you? Are you Indian citizen? Are you Indian citizen? No. Current year, he stayed for 100 days. Left side, left side. Left side. Come to the left side. In the left side, are you leaving India for employment? No. No, which means you need to check for condition number 2. Condition number 2 says you should stay in India for. Has he stayed for 60 days? Condition number 2 says you should stay for 365. Last 4 years he stayed for 400. Current year he stayed for 100. Last 4 he stayed for 400. Satisfied conditions. You are resident. You are? With you being resident, you need to check for 2 conditions. Leave condition number 1. Come to condition number 2. You have to stay for 730 days. You stayed in the last 7 years for 700 days. Satisfied, not satisfied? Okay, ulta. Okay, fine. You have not satisfied ROR conditions. You have satisfied RNOR conditions. Therefore, you are. Easy? Hello? What would be your answer if this person was nothing but Srinath? If this person was Srinath, who is an Indian citizen who is residing in Australia and represents Australian cricket team. Who is he? He is an Indian citizen. He is an Indian citizen. With he being an Indian citizen, is he coming to India for visit or for permanent settlement? He is coming to India for a visit. If he is coming to India for a visit, you need to ask yourself whether his total income is more than 15 lakhs or less than. Yes or no? Yes or no? No. Why? The current year stay itself is less than 120 days. Yes or no? Our current year stay itself is less than 120 days. That's why total income correct or not? When his stay itself is less than 120 days, which means no matter what you are, your income is always non-resident. Therefore, you are directly. You want me to lengthen it? Sorry, let me lengthen it. Let's say assuming your total income is more than 15 lakhs, your stay in India should be 120. He stayed for 100. Therefore, he is non-resident. Your total income was less than 15 lakhs. Your anyway stay is non-resident. Therefore, you are a. Okay. What would be your answer if Srinath had visited India for 120 days instead of 100 days every year, including the current year? including the current year. You are an Indian citizen coming to India for a visit. Stay in India is 120 days. Stay in India is 120 days. Are you resident, non-resident? Very good. Check for your income. Now you need to check for your income. If your total income, correct? Huh? Yes. If your Indian income is more than 15 lakhs, then you will become an RNOR. You become an RNOR. Why, ma? Because current year it is 120 days. Last 4 years it is 480 days. Last 4 years it is 480 days. You satisfied the condition, directly become RNOR. Directly become RNOR. If you were total income less than 15 lakhs, you will become NR. So there are two options. Either it is NR or it is RNOR. Yes or no? Yes or no? When it is NR, if it is less than 15 lakhs, if it is more than 15 lakhs. Clear? Yes? Yes. I'm only giving you the final answers. The solution is something you need to prepare. Solution is something you need to prepare. Go home and write your own theories. Okay? I will give you a format at the end of the batch. At the end of the batch, I'll give you a format for how the question should look like. That is the only time I'll tell you. At the end of the day, you need to go home and practice these sums back again. Okay? Question number 4. You are required to determine the resident status of Mr. Sundaram. Mr. Sundaram is Sundaram HUF. You are a Sundaram HUF who is carrying out his transactions in Malaysia. You are in? Its affairs are partly controlled from India, which means HUF is resident. HUF is resident. Hold. The Karta of the HUF, Mr. Sundaram, who is from Chennai, visits India on 1st June 2022 and leaves to Malaysia on 10th February 2023. He has not visited India in the last 11 years. The last 11 years. But still, let's check what is the Karta's status. Karta has come to India on 1st June 22, has left India on 10th Feb 23. 1? Chacha? Your current Karta is staying in India for 132 days. Has he satisfied the condition of 182? No, which means he is a non-resident. Which means he is a non-resident. So, since Karta is non-resident, HUF is also non-resident, correct? Karta is non-resident. நான் சொல்ல நீங்க தான் சொன்னீங்க. எப்படிமா பண்ண பேக்வர்க்கா பண்ண? சரி, ஜூன்ல இருந்து பிப்ரவரிக்கு பின்னாடி போனியா? எப்படி பண்ண நீ? ஜூன்ல இருந்து பின்னாடி போனியா இல்ல ஃபெப்ல இருந்து ஆரம்பிச்சியா? ஃபெப்ல இருந்து ஆரம்பிச்சா? People are running back in time now. What is it? Resident, non-resident? It is coming as 255. Guys on the online, not my mistake. People here are doing mistakes. Okay. Yes, this is 255 days. Karta is now a resident. With Karta being a resident, you need to now check for the last 2 years condition. That the person has not come in India for the last 11 years, which means he is the RNOR. With the Karta being an RNOR, you are also, who is you? HUF also becomes. Doubts clear? Next. You are required to compute the total income in the hands of an individual whose age 35 years. He can either be a resident and an ordinary resident, resident and not ordinary resident, or an non-resident. So I will give you 3 scenarios: ROR, RNOR, NR. I will fill ROR, you will fill the balance too. I passed now. Yes, I will fill the ROR, you will fill the RNOR and NR. Okay. First one, interest on UK development bonds. 50% of the interest is received in India. ROR taxable amount is 10,000. RNOR amount is 5,000. Why? Only 50% was received in India. Yes. Next one, income from a business in Chennai. 50% is received in India. 20,000 for ROR. Why? Income directly accrued in India. Income directly accrued in India. Next one. Short-term capital gains on sale of shares of an Indian company received in London. Taxable for me. What happened to you? Yes, people. Amount taxable is 0 or 20,000. Hi. It's an asset of an India. Income deemed to accrue or arise in India directly becomes fully taxable. Section 9. Then dividends from a British company received in London. Enge ponalo enage taxable now. For you. For whom? And who are not taxable and are taxable. Okay. Long-term capital gains on sale of plant at Germany. 50% of profits are received in India. You story. And 40,000 fully taxable. Huh? 20,000 each. Income earned from business in Germany, which is controlled from Delhi. 40,000 is received in India. For me, 70,000 taxable. For R and Noir. Huh? Why? R and Noir full 70,000 taxable because the business is controlled from India. NR 40,000. Next one. Profits from business in Delhi managed entirely from London. 15,000 fully taxable for me. R and Noir. Huh? Why? Business itself is in Delhi. When the business itself is in Delhi, it is accrued in India. Nada sunnala India vaartha vandale taxable na. Income from a house property in London deposited in an Indian bank at London brought into India. Income from a house property in London deposited in an Indian bank at London brought into India. Okay. Taxable for me. Taxable for me. Taxable for me. Why? There are two transactions happening here. There are two transactions happening. Transaction number 1 is you earned the income. Transaction number 2 is you remitted the income. On the earning part, it is still taxable. Remittance alone is not taxable. They never clarified that the remittance is happening on a later year. On the earning capacity, I am taxable. On the remittance capacity, I am not taxable. So on the earning part is where I am taking tax. Therefore, it is taxable. Come to the R and Noir. R and Noir. Not taxable. NR. Hey, Rahul, Indian bank irukku. It doesn't matter. It doesn't matter. It is not about income received in Indian names. It is income received in India. Yeah. Summa or India pair potale, it does not become taxable. Nalika and the John T. Rhodes son's name is India only. John T. Rhodes, you know who's John T. Rhodes? He's a fielder. He's a fielder. He got super impressed with India that he kept his child name as India. I cannot come and say, boss, India pair vechirke royalty kuduturu. Correct, huh? Just because India is earning in India outside India does not mean she's taxable in India. Correct, huh? Interest on debentures in an Indian company received in London. 12,000 fully taxable. R and OR. Why? Very good. Shares are pertaining to an Indian company. Fees for technical services rendered in India received in London. For me, it is fully taxable. For you? Why? What is the use? What is the use? It is used in India, therefore it is taxable in India. Profit from a business in Mumbai managed from London. Business itself is in Mumbai, it becomes accrued in Mumbai. Income from property situated in Nepal, received there, computed fully, 16,000 in my hands, fully taxable. R and OR. Undivided India. Undivided India. Undivided India is only to the extent of you understanding what is a person of Indian origin. Does not change the fact that it is not India anymore. Okay, Nalik, you cannot go marry someone there and say it's an Indian person. No. Yes, income from agriculture land in Nepal received there, brought into India. Income from agriculture land in Nepal received there, then brought into India. For me, it is taxable. Why? 5,000 miss pantana. Sorry. Past untaxed profits brought into India during the previous year. ROR, not taxable. RNOR, not taxable. NR, not taxable. Next one. Income from agriculture land in Nepal received there, brought into India. For me, fully taxable. Why? Two transactions happening. Earning transaction taxable. Remittance transaction not taxable. Come to the other two. Huh? Income from profession in Kenya, set up in India, received there, spent in India. You. ROR taxable. RNOR. Huh? Taxable, not taxable. Why? Profession is set up in India. NR. NR. Spent in India. Spent in India. You only check from the income side. You don't check the expense side. You don't check the expense side. You only check the income side. Gift received on occasion of wedding. While it is an income, it is not taxable because of IFOS. Because of IFOS, it is not taxable. Wedding gifts are exempted from tax. Where are you? Interest on savings bank deposit in State Bank of India, 12,000 rupees. ROR taxable. ROR taxable, 2,000 rupees. Correct? Huh? Correct? Huh? ROR taxable amount is 2,000 rupees. Correct? Not correct? Correct or not correct? Correct. You are getting a deduction of 10,000 rupees under section 80 TTA. Under section 80 TTA, you will get a deduction of 10,000 rupees. Not in the specific head, but in the chapter 6A. In the chapter 6A, technically you should put it as 12,000 and then put the whole income and then show it as a deduction. I am a little lazy, that's all. Okay. For the RNOR. Interest on savings bank deposit in State Bank of India. RNOR. Taxable, not taxable? Taxable. SBI is in India only, no. NR. Taxable. Income received in India. Income received in India. Income from a business in Russia, controlled from Russia. 20,000 fully taxable for me. Dividend from a Reliance Petroleum Limited Indian company. Huh? Dividends from Indian company deemed to accrue or arise in India. Agriculture income from a land in Rajasthan. Exempt from taxes. Correct? Huh? I told you yesterday what? Did I ask you to make it exempt? No, I told you to follow. Be careful. Rent received in respect of house property at Bhopal. Huh? Taxable amount is 70,000. Understand, ma? See the word. It says rent received. It says rent received. Now is the case where they are clarifying it is not an income. That is why we are deducting 30%. Understand, it is saying received, which means what in your hand you have is your receipt. What you have in your hand is your receipt. It is not the income. I want the income. Income is nothing but 30% reduced. In the earlier question, it was income. Careful. 70,000 for ROR. NR. Same. NR. Same. LIC paid in India. Total all these items reduce 80. C number is 30,000. Hey, RNOR eligible for 80C. Yes, sir. Yes. NR eligible for 80C. Yes or no? Yes. Yes. Okay. What doubt? அதான் நான் சோம்பேறி வேற ஒண்ணு. Ideally speaking, this should be 12,000, 12,000, 12,000. You should reduce something called as 80 TTA. Ipo okay, ma? Yes, yes. This will total up to your incomes. Quickly total so that you can put it in your book. Quickly total so that we can put it in your books. ROR is 4 lakh 2,000. Okay. Hey, I am not verifying the numbers. You take care of it. Acha, okay. Did you take 12,000 on the top or 2,000 on the top? 12,000. Okay. One second. Yes, ROR is which one? Total or last term? Without deduction. 2 lakh 88,000. 2 lakhs? What? 50 ma? How can R and OR have lesser income than R and R? All facts remain same at no given point of time. Can it be possible that an NR can have lesser income than an R and OR? Give me the final numbers. 3 lakh 62,000. R and OR is 2 lakh 48,000. NR is 13. 2 lakh 13,000. Done? You can note this down in your books. Tomorrow when you practice the sum, the same number should come for you. Alright. Can we go to the next one? Mr. David. He is a citizen of India who's aged 40 years, a government employee, and is serving in the Ministry of External Affairs. Who is he? Salary received by a central government employee outside India. He has left India for the first time on 31st March 2020. Your previous year, previous year. It is previous year. Your previous year starts on 1st April 22. 31st March itself he left, which means in the current year he was there for 0 days. He was there for 0 days. He did not visit India at any time during the previous year, which means current year stay is 0, which means he becomes NR. He becomes NR. With that, you have been given the following information. Salary is given as computed 5 lakh rupees. Salary is given as computed 5 lakh rupees. Taxable, not taxable? Taxable. Foreign allowance? Not taxable. Interest on FD from bank in India. Income from agriculture in Nepal. Why? Very good. Income from agriculture in Nepal becomes not taxable because of you being a non-resident. Income from house property in Nepal. Total income is claim 80 TTA. Correct, huh? Huh? Eligible dama. 80 TTA allowed, not allowed? Allowed, not allowed? Not allowed. Why? Only savings is allowed. Only savings is allowed. The break motion which I wanted to put forth is non-residents are also eligible for 80 TTA. Only if it is a savings. This is your total income becomes compute tax. Hey, non-resident age வேணாம் உனக்கு. Huh? 15 0 80. Okay. Number matched. Number matched. என்னம்மா நம்பர் தட்டுறதுக்கு இவ்வளவு டைமா? டேய் அடா நேத்து தானே படிச்சோம். What is the number, ma? Huh? What is the number? ஏமா பிரச்சனை? 33 800. Correcta? Correcta? Did you check for 115 BSc? Did you check for 115 BSc? Yes or no? Did you follow the golden rules? Yes or no? நேத்து என்ன சொன்னேன் நானு? 28? Wrong. How did you get it? Wrong. Wrong. Where are you missing? Where are you missing? What is the total income for 115 BSc? What is the total income for 115 BSc? Huh? 6 lakh. Huh? Day salary is given computed. That means it is already given standard deduction. If you want to check for 115 BSc, your total income becomes நேத்து தானே பண்ணோம். You see where the mistakes are happening? We're repeating the same kind of mistakes we did yesterday. Same kind of mistakes are happening again and again. 3 things we discussed: to always check for 115 BSc, to always give your standard deduction properly, to always be a check for non-residents. Guys, buckle up. Okay? Things are not as simple as they look at it. Okay? These questions are what come for MCQ. These questions are what come for MCQ. They will straight out give me the tax liability. You have now 4 options in your hand. You check for not 115 BSc, you check for 115 BSc with standard deduction. That itself was a sin. Yes or no? Careful. Careful. Okay? You have a tax liability of 33,800 in your not 115 BSc and a tax liability of 28,600 in your 115 BSc. In this scenario, you'll opt for 115 BSc. Clear now? Careful, careful. Okay? Careful. Yes? Will you not make the mistake next time? Yes, sir. No. Yes, na. Will you make a mistake? Illa, will you not make a mistake? You are required to determine which of the incomes are taxable. Point number 1. Mrs. Vivita is paying a sum of 5,000 USD to Mr. Kulasekara, a management consultant practicing in Colombo, specializing in project financing. The payment was made in Colombo. What the hell are we talking about? Royalty. FTS. It is FTS. Who is Mrs. Vivita? I don't know. She is paying to someone called Kulasekara who's sitting in Colombo. Kulasekara is recipient, payer. Recipient. Will you check from recipient side or the payer side? Check from the payer side. So what has happened? Kulasekara is a non-resident receiving 5,000 rupees USD for FTS. What is going to happen? The payment is made in Colombo, which means payment is outside India. Mr. Kulasekara is non-resident. The consultancy is specialized to a project in India with possible Celanese collaboration. Mrs. Vivita is going to use for this as a project in India. Taxable for whom? Taxable in India, yes or no? Taxable in India. Taxable for Vivita yaar sunna. ஏமா நீயே காசு பே பண்ணிட்டு அதுக்கு மேல நீயே டாக்ஸ் கொடுக்க போறியா? You will itself incur the expense, you will itself pay the tax on it, correct? Correct? Whose is an income for? Kulasekara. It's an income for Kulasekara and it is taxable. And it is taxable. Yes or no? Yes. Your salary is paid by the central government to Mr. John, who is a citizen of India. 7 lakh rupees for services rendered outside India. Taxable, not taxable? Taxable. Why? Salary, central government employee, fully taxable. Interest on money is borrowed from outside India by a non-resident for the purpose of business within India. Say at Mumbai. You've got interest from outside India. Money is going to be used for India. Taxable, not taxable? For whom? Whoever gave the loan. Whoever gave the loan. Royalty paid by a resident to a non-resident in respect of a business carried on outside India. Taxable, not taxable? Not taxable. Uses outside India. Legal charges of 5 lakhs paid in Delhi to a lawyer of UK visited India to represent case at a Delhi High Court. First, tell me the nature. Hey. Tell me the nature. FTS. With you being an FTS. Received by lawyer for services in India, outside India. In India. Taxable. Yes. For whom? Lawyer. Follow the steps, people. Don't jump. The moment you jump, only this 115 BSc nonsense happens. 20 lakhs received by a non-resident from a non-resident for use of patent of a business in India. Taxable for non-resident. Royalty is received by the non-resident, so it is taxable for the non-resident. 15 lakhs by a NR from a non-resident Indian. Non-resident Indian for the use of know-how for a business in Sri Lanka, and this amount was received in Korea. Indian, ma? Indian. It's not about non-resident, it's the use. Use is happening in Sri Lanka. Use is happening in Sri Lanka. Since the use is in Sri Lanka, it becomes not taxable. 5 lakhs is received by a non-resident from R&Co company, Mumbai, resident in India, conducting feasibility study for new project in Nepal. Payment was made in Nepal. Too much facts. Once again. 5 lakhs received by NR from R&Co, resident in India, conducting feasibility study for a new project in Nepal. Payment is made in Nepal. Taxable, not taxable? Not taxable. Why? Nepal is in India. ICP. 5 lakhs, 2 crores. Interest received by NR from Mr. Marshall, non-resident outside India. Borrowed fund is used by Mr. Marshall for investing in Indian companies' debt funds for earning interest. Not taxable. Interest has an exception. Paid by a non-resident only for the purpose of business and profession in India. This is for IFOS. 10 lakhs received by NR in Japan from a business enterprise in India, granting license for computer software. What is this first? What is this first? What is this first? What is this? Right here. What technical are you providing? No? Right. Are the technical? This is royalty. This is royalty. You have given a software to someone else. The payment is happening for the software. Therefore, this is royalty. Royalty is paid by business enterprise in India for, to a non-resident. Taxable, not taxable. Taxable, not taxable. Taxable. Nothing is given in the question. Therefore, we will assume that the royalty resident is going to use it for India. 10 lakhs is received by a non-resident engaged in the business of running news agency for collection and news and views outside India. Straightforward and exception. Straightforward and exception. Collection of news and views outside India becomes not taxable. Mr. Pratham is a non-resident in India. Received a sum of 1,14,000 from Mr. Rakesh. A non-resident has received a sum of 1,14,000 from Mr. Rakesh and ROR. The payment was made to Pratham on account of transfer of right to use manufacturing process developed by Pratham. English short form is royalty. The manufacturing process was developed by Pratham in Singapore. Rakesh used such process for business carried on by him in Dubai. Taxable by resident has used the payment for a royalty for outside India. Clear? Last question. Daisy Limited is a foreign company incorporated in USA, engaged in the manufacturing and distribution of diamonds. Set up a branch office in India in June 2022. You have a foreign company incorporated in USA, engaged in distribution of diamonds. The branch office is required to purchase uncut and unassorted diamonds from Mumbai and export them to USA. During the previous year, the profit from the export is given as 75 lakh rupees. You are first told that the shareholders of Daisy Limited are 20 people, out of which 12 shareholders are non-residents. All the decisions are happening in USA, which means the foreign company is a non-resident. Why? The poem has become outside India. You are required to determine the status of Mrs. Daisy. NR. What is the tax treatment for the profit of export business? Taxable, not taxable? Huh? Taxable, not taxable? Taxable. Why? See, display of only display is permitted. Sale is taxable. Correct? Huh? It is for export. Purchase of goods for the purpose of export becomes non-business connection, becomes not taxable. While you might not be displaying, you are still doing an export. You're still doing an export. Purchase of goods for the purpose of export becomes not taxable. Both are independent scenarios. This is how ICA played with you in that exam. Okay, this was an exam question, not my question. Exam question, ICA played wonderfully. Everyone came and said, boss, no, display only is not taxable. This is pure sale. Therefore, fully taxed. Answer also became fully zero. Okay. Understand all the exceptions independently. Independently, this is a purchase for the purpose of export. With the purchase happening for the purpose of export, this directly becomes a exception to your business connection, will become clear. Any doubts? Safe now? Chapter number 3 looks comfortable. You have any doubts? Any kind of question which could have come in chapter number 3 is what I've already compiled and given to you. Idikmala, I don't expect any further questions coming in. Read these questions. You should be sufficiently safe enough. Okay? Yes? Done. We are done with chapter number 3. I want to go for a short break, but I will not leave it right away. So what we are going to do is we are going to do HP first and then we'll go for a short break. Okay? We are skipping salaries and we are going to HP. We will complete HP, then we'll take a break and come back and do as promised. Yes? We are right now into the chapter called as HP. Pasigdama? Hungry? I am hungry. I have not eaten the lunch today. Great. Coming to the next head of income, we are into the head of income called as income from house property. We are into the income called as income from house property. Guys, I don't know if people are watching on YouTube or not. Vote in Irka first. Great. We are into the chapter called as HP. We are into the second head of income. We are into the second head of income. Coming to the second head of income. Okay, we'll discuss later. Coming to the second head of income, we are into the income from house property. Rules are very simple. Whenever you start a head of income, the first thing and the most important thing is to understand your charging section. To understand your charging section. Let's look at the charging section. It comes and says annual value of any house property which is an owner of the assessee will become taxable under the head house property. If you have a house property and your assessee is the owner, the annual value of that will become taxable under the head house property. Three things: annual value, ownership, house property. So you need to first understand what do you mean by a house property. While I sit and debate a lot about house property, in a simple term, house property means anything which has four walls. Anything which has four walls and is connected to the land. And is connected to the land. Anything which is connected to the land has four walls will be treated as a house property. It does not matter whether it has a roof or not. Does not matter whether it has a roof or not. A swimming pool put into four walls are also treated as a house property. Yes or no? Yes or no? Yes. It is treated as house property. As long as the swimming pool has the four walls, it is treated as a house property also. Yes, that is what is treated as a house property. Having said that, we now need to understand what do you mean by ownership. What do you mean by ownership? Income tax comes and says only if you are the owner of the house property will it become taxable under the head house property. If you are the sub-owner of the house property, it will be taxable under the head PGBP or IFOS. Meaning, first lease is taxable under HP, second lease becomes taxable under PGBP or IFOS, depending on the facts. There is only one exception. There is only one exception. The exception comes and says that if you are having this property for more than 12 years, if you are having this property for more than 12 years, you are deemed as the owner of the property. Deemed as the owner of the property. Section number 27, last one. Section number 27, last one. Here it comes and says where you have had the property continuously for more than 12 years, it is deemed that the tenant is now the owner. With the tenant now becoming the owner, if the tenant now gives the property to someone for rent, that will be treated under the head HP. That will be treated under the head HP. Clear till here? Yes. So now we have discussed what do you mean by HP, what do you mean by ownership. Ownership, there are some deemed ownership concepts. Ownership has some deemed ownership concepts. The first deemed ownership concept comes and says, if you give this property to your spouse, you give this property to your spouse and you have given it for inadequate consideration, the owner will be the actual owner. The owner will be the actual owner. We will deem the actual owner as the owner. The next person will not become the owner. The next person will not become the owner, meaning a transfer of house property to your spouse for inadequate consideration, the first owner will still continue to be the deemed owner. What do you mean by inadequate consideration? Anything lesser than market value is treated as inadequate. Anything lesser than the market value is treated as inadequate. Can my love and affection be treated as a consideration? Can my love and affection be treated as a consideration? Yes. It can be treated as a consideration. It cannot be treated as an adequate consideration. Don't make me feel sorry. You would have learned it in Contract Act. You would have learned it in Contract Act. Love and affection is a consideration. It is just not an adequate consideration. And here we are deliberating about inadequate consideration. Is it a consideration? Yes. Will it value you? No. Yes? No. 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 Okay. A transfer of an house property to your spouse for inadequate consideration, the deemed owner will continue to be the main. Yes. Next one. A transfer of the house property to your minor son. Transfer of house property to your minor son or minor daughter will be treated as a deemed ownership in the hands of the parent. Will be treated as a deemed ownership in the hands of a parent. Only one exception given to you. They have come and said if it is transferred to your minor married daughter. If it is a transfer to your minor married daughter, it will not be taxable in the hands of the main owner, but it will be clubbed in the hands of the parent. Be clubbed in the hands of a parent. HP will not apply. Clubbing will apply. HP will not apply. Clubbing will apply. Question to you. It will be taxable in the hands of whom? Which parent? Which parent? Which parent? Na your own parents are Husband oda parents ah. In-laws. Will be taxable in the hands of in-laws. Technically, when you have married and gone there, you have become a part of their family. You have become a part of their family. In India, we come and say you are Paraidan now. Paraidan is basically, I don't know how to explain it. I don't know how to explain it to you. Paraidan is basically you are not. I don't know who you are. Hum aapke hai kaun? Something like that. Whatever it is. Yes, you are treated as a Paraidan, which means you are not a part of my family anymore. You are a part of their family. You are a part of their family, which means the burden of income is also on them. The burden of income is also on them. So it becomes taxable in the hands of in-laws. Which in-law? Which in-law? Which in-law? Father-in-law or mother-in-law? Whosever income is higher. It will be taxable either in the hands of the father-in-law or the mother-in-law, depending on whose income is higher. Depending on whose income is higher, the clubbing provisions will apply. The clubbing provisions will apply. This provisions will not apply. Clear? Yes. These are the only two which you need from exam perspective. These are only two which you need from exam perspective. Balance you can ignore. Balance you can ignore. It's not coming from exam perspective. From exam perspective, if you transfer it to your spouse for inadequate consideration, the original transferor will continue to be the deemed owner. If you transfer it to your minor child, then also it will be treated as in the hands of the original transferor. But if it is a transfer to the minor married daughter, clubbing provisions will apply and it will become taxable in the hands of the in-laws parents, whosever income is here. Yes, this is what the provisions are when it comes to deemed ownership. Having understood what is your house property and what is your ownership, we now need to understand what do you mean by an annual value. This is where in every chapter you will find a format. You find a format. The format in HP looks like this. The format in HP looks like this. Follow the format religiously, the answer will always come out right. Follow the format religiously, the answer will always come out right. But before you get into the format, you need to first classify your house. You need to first classify your house. The classification of house works in this format. If you live in your own house, it is called as SOP. If you have given it to someone else, it is called as LOP. But if you live in your own house, they are giving you restriction of 2 houses. They are giving you restriction of 2 houses. They are like you can have 1 leg in one house, 1 leg in another house. But beyond that, you don't have any more legs. Beyond that, you don't have any more legs. So the third house will now become DLOP. The third house will now become DLOP. Basically, you have let out it to yourself. You have let it out to yourself. So, as a part of the rules, LOP property is LOP property. But when it comes to SOP property, only 2 properties can be treated as an SOP property. Third property will become DLOP. Question to you: which property should be treated as SOP? Which property should be treated as DLOP? That's your option. Whose option? Assessee, assessing officer. At the option of the assessee. At the option of the assessee. Can you change it every year? Can you change it every year? Can you change the option every year? Yes, you can change the option every year. It is not permanent. You can tell today that I want H1 as the LOP. Tomorrow you can tell H2 as LOP. It is okay. It is also okay. Yes or no? Yes. This is what the provisions are when it comes to SOP and LOP. But here is where they've given an exception. They've come and said, boss, if you are a person who's holding the stock in house property as a stock in trade, you're holding the house property as a stock in trade. Your business was to sell the property, get rent. Sell the property, which means you getting rent will be taxable under the head. Your house property is held as a stock in trade. You have got rent from the property. Income will be taxable under the head. Why IFOS? Why IFOS? Very. You're not selling the house, now you're getting rent from the house. Taxable under the head. Hey, Purili example. புரிஞ்சுதா? அது முன்னாடியே சொல்லிருக்கணும்ல. You are Casa Grande. யாருன்னு தெரியும்ல? You are Casa Grande. Okay. You have built a building. In this building, there are 200 flats. Guys, focus. In this building, there are 200 flats. In this 200 flats, you have sold 150 flats. Sold. Balance 50 flats are with stock in trade. Balance 50 flats are as stock in trade. Question to you. This 50 flats he was not able to sell, so that he gave it for rent. He gave it for rent. 50 flats, he gave it for rent at the rate of 1 lakh rupees per flat. At the rate of 1 lakh rupees per flat. Total income for him is 50 lakhs from rent. Taxable under the head. Why?
It's not sale of business. If it is sale of business, then it is
PGBP. Cherry.
It's not sale of business. From other sources.
This is rental income taxable under the head HP. Look at the charging section. Annual value of the property of which the assessee is the owner. Are you the owner? Is it a property? Is it your property? Are you taxable under HP? IFOS is a garbage section. What does not fall into the other heads goes into IFOS. This is already getting covered here. Yes or no? Taxable under the head. Taxable under the head HP. Till now, clear or not clear? Clear? Yes. Question to you. What has happened is you had 50 flats. You gave all the 50 flats for rent. So therefore, it was taxable under HP. Taxable under HP. Unfortunately, what happened? You could not give all the 50 flats. This is your property. Yes or no? This is your property. Yes or no? Should be treated as DLOP. Should be treated as DLOP. But is it your mistake that it is not being sold? They give you a window. They gave you a window. They came and said, boss, for the next 2 years, I will not tax it. I will not tax it. 2 years later also, if you're not able to sell, I will deem it as an L. I will deem it as an L. That is what the criteria is. What is the criteria? For the next 2 years. For the next 2 years from where? From the date of completion of the property or from the date of end of financial year? From the end of the financial year. From the end of the financial year. The date on which you complete your property and the date end go to the end of the property, go to the end of the financial year. From there, 2 more years. From there, 2 more years. They will give you time for 2 more years. Until that, if you are not able to complete your property within the next 2 more years, it will become taxable in the hand, taxable under the head HP as DLOP. Which year? From today or from 3rd year? From today or from 3rd year? Just because I'm asking weird question does not mean the answer will change. Okay, it will be taxable only from 3rd year. It will only be taxable from 3rd year. Clear or not clear? Clear? Sure, 100%?
April only construction is getting completed.
31st March, 2 more years. Yes. Trade. In case of an house property held as stock in trade, GAV shall be considered as nil for a period of 2 years from the end of the financial year in which the certificate of completion is received for the construction of house property from the competent authority, even if the same is not. Clear? Clear? But yes, if you had let out the property, then it is definitely taxable. Only when it is an SOP property for unsold stock. SOP property for unsold stock, 2 years from the end of the financial year is when it will become taxable. MCQ question, be careful about it. Okay? Yes, having understood this, now we need to understand our format. Let's understand our format. We have 3 kinds of properties now. One is called as an SOP property, LOP property, DLOP property. Yes, we have a format where we need to first understand what is our GAV. We need to understand what is our GAV. To understand what our GAV, they have told you to compare 4 rents. Rent number 1 is called as municipal rent. Rent number 1 is called as municipal rent. The format says it is municipal rent or fair rent, whichever is municipal rent or fair rent, whichever is higher. That will be compared with your standard rent, whichever is lower. That will be compared with your actual rent, whichever is higher. And this will arrive at your GAV. Let me clarify it once again. It is municipal rent or fair rent, whichever is higher, compared with the standard rent, whichever is lower, compared with the actual rent, whichever is higher. In this, what does the municipal value mean? Municipal value means the rent which municipal authorities will collect. How do you compute that? You take municipal tax divided by the municipal tax percentage. Municipal tax divided by municipal tax percentage. Whatever the tax rate which they ask you as municipal taxes, divided by the municipal tax percentage will give you the municipal rent. Will give you the municipal rent. What is fair rent? Fair rent is something which the market will charge. The market in the asset rent is the final answer. So it is municipal rent or fair rent, whichever is higher. Then comes standard rent. What is standard rent? It is the rent which is fixed by a rent control act. Rent fixed by a rent control act, that is called a standard rent, whichever is lower. This is called as your ER. Expected rent. This is called as your ER, nothing but your expected rent. This expected rent is what government is expecting out of you. Government is saying, this is what I want from you. This is what I want from you. Give me this much, I'm happy. Give me more, I'm even more happier. Give me anything less, I will collect this much from you. I will collect this much from you. So this is called as expected rent. This expected rent is compared with your whichever is by, because government is saying you give me bare minimum this much. Because the government is saying give me minimum bare this much. If you give me this much, great. If you don't give me this much, I will collect it from you. Okay. Therefore, it is expected rent or actual rent, whichever is higher. This becomes your GAV. This becomes your GAV. From this GAV, you reduce one item called as municipal taxes paid only by the municipal taxes paid only by the two conditions mandatory. It should be paid. It should be paid by the owner. If you have not paid, not eligible. If you have not paid, not eligible. What? If you have not paid, not eligible. If you have not paid, not eligible. What is the difference? If you have not paid in the current year, not eligible. If you have not paid itself, clear? Clear? Question to you. Municipal tax of current year not paid. Current year not paid. Next year also not paid. Third year also not paid. Fourth year, all four together paid. Allowed or not allowed? Allowed when? In the fourth year, you can come and claim all the three rents. The fourth year, you can come and claim all the three taxes. Yes or no? Yes. Next question. You have paid municipal taxes in London. You have a property in London. You have received rent in London. You have paid municipal taxes in London. Allowed or not allowed? Allowed or not allowed? Allowed or not allowed? Anyone not allowed? Huh? As per that law. Hey, you are a resident in India. You are a resident in India. You have a property in London. Adoda income unukku taxable illaya? அதுக்கு நீ ஒரு municipal tax pay பண்ணிருக்க. Allowed or not allowed? Municipal tax paid in foreign countries are also permitted as a deduction. Clear? Clear? With your municipal taxes getting reduced, you will now arrive at something called as NAD. You will arrive at something called as NAD. Yes or no? Before we get into NAV itself, two things for you to check. One is something called as vacancy loss. The other is something called as unrealized rent. Two items for you. What is it? Vacancy loss, unrealized. What the hell is this logic? The answer is like this. You had a property which you were supposed to let out from 1st April of 20. Previous year. You had to let out this property from 1st April of 22 to 31st March 23. You had supposed to let out this property for 12 months. Yes. You decided that the rent for each property would be 6,000 per month. The rent for the property would be 6,000 per month. What happened is you tried to give the property for rent. At the price of 6,000 per month. You sat and you computed income tax also. They said, boss, ER is only 5,500 per month. How much is the ER? Government is expecting 5,500 per month. You are ready to give 6,000 per month. Government happy, not happy? Happy, super happy. Yes, government is happy. But the problem what happened is you wanted to give this property for 6,000, but no one was ready to take the property for 6,000. So what happened is from April to October, property was vacant. You only got the tenant in the month of November, which means he was there from November to March. Tell me, your expected rent is for per month. Total expected rent for the year will be Your total rent will be 66,000 as expected. 66,000 as expected. I use the word actual rent. I use the word actual rent. What is your actual rent? 6,000 into 5 months. 6,000 into 5 months. 30,000. Question to you. What is your GAV? What is your GAV? What is your GAV? 66,000. Why? What is? Your GAV is 30,000. Why? Why? Understand, people. If you would have got the property on rent, you would have given the government 72,000. Are you a good human being, bad human being? If you are a good human being, should the income tax department penalize you for being good? They will not penalize you for being good. So they came and said, boss, if you are a good human being, you were ready to give me 72. Genuinely, you were not able to give it for rent. So therefore, I should not penalize you for that. I cannot expect you to pay 66. I cannot expect you to pay 66. I definitely cannot expect you to pay 72. Kaiye kaas varame FD pay pandrathu. Correct or not? In this scenario, I will let you pay. I will let you pay the actual. I will let you pay the actual, which is nothing but your 3,000. Purida, Puridia. This is called as vacancy loss. This is called as vacancy loss. What do you do is when you are comparing your expected rent and actual rent. When you're comparing your expected rent and actual rent, you are not comparing the actual rent. You are comparing the actual rent receivable. Comparing actual rent receivable. What was your actual rent receivable? 72,000. Your actual rent receivable was 72,000. If you figure out that your actual rent receivable was higher, your GAV would have been 72. GAV would have been 72. But genuinely you incurred a loss, so government is giving you the benefit of loss. Government is giving you the benefit of loss, in which case your GAV will become 30,000. Purida, Puridi. Rahul, what happens when the scenario changes? What happens when the scenario changes? If you were already planning to only put it for 5,000, you were already planning to put it for 5,000, your total year rent would have been 60. Your total year rent would have been 60. You would have compared 60 with 66. You would have compared 60 with 66. Your GAV would have been. Will government give you benefit of loss? Why? You were anyway a bad citizen. Nee starting in the Aramikkamode, you told I will cheat you only. If government, you are ready to cheat, government is ready to cheat back. Okay? In this scenario, government said, boss, had you taken the property on rent for the full year also, you would have only got 66 only. Why should I give you the benefit of loss and make my loss? Yes or no? So government said, in this case, vacancy loss will not be granted. Vacancy loss will not be granted. In summary, when you are checking your actual rent, you will not check your actual rent. You will check your actual rent receivable. Check for your actual rent receivable. Compare it with your expected rent. If your actual rent receivable ends up being higher and you find out that you are a good citizen, please claim your vacancy loss. If you find out that your actual rent receivable is anyway lower, claim your GAV as your expected rent and close the answer. No vacancy loss permitted to you. Clear? Not clear? Clear? Sure? Yes? Let's do an example. Look at the example. Your expected rent is given in the question as 2,10,000. Okay. Your monthly rent is given as 20,000 rupees. Your monthly rent is given as 10,000 rupees. You had a 2 months vacancy. If you ignore the vacancy, how much rent would have you got? 2,40,000. Would you be a good citizen, bad citizen? Why? Government was only expecting 2,10,000. You were ready to give 2,40,000, but you were not able to give him 2,40,000. So government will give you the benefit of vacancy loss, which means you will only pay the government now 2 lakhs, which is nothing but your 20,000 into 10. Clear? Yes. Next one. Case number 2. Your expected rent is 2,50,000. You are giving a rent of 20,000. Your total rent would have been 2 lakh. Were you cheating government, not cheating government? If you were cheating government, government will take the GAV as 2 lakh 50. Will you get the vacancy loss? No. Come to case number 3. Your expected rent is given as 2 lakh 40. You were ready to pay the government 2 lakh 40. Good citizen, bad citizen? Nothing. Same. Neutral position. Neutral position. In a neutral position, government will come and say, what? Boss, you were ready to give at least what I'm expecting out of you. You were ready to give at least what I'm expecting out of you. Will he give the loss? Not give the loss. He will give the loss. Your new rent will become lakhs. Your new rent will become 2 lakhs, which is nothing but 20,000 into 10. Clear? Not clear? Yes. This is the first concept called as vacancy loss. Next concept is unrealized rent. Rahul, what the hell is this unrealized rent? Bad debts. In a very simple term, it is your bad debts. Basically, what happened is in this question. 1 second. In this question, I told you that the property was vacant from April to October, but the property was occupied from November to March. But for some reason, your luck was so bad that the person who's there in the property is also useless. The person who's there in the property is also useless. What he did is he properly paid you the rent for November, December, January, February. November, December, January, and February, but forgot to pay you the rent for March. You went and you tried collecting it from him. He said, "Get lost, I will not pay the money." This is now bad debts. This is now bad debts. This bad debts is called as unrealized. What happens on income tax for this? They say, boss, whatever is your unrealized rent, please reduce it from your actual rent. Please reduce it from your actual rent fully. Please reduce it from your actual rent fully. Because of it, the biggest problem which happens is now your expected rent is 66. Your expected rent is 66. Your actual rent was 72, correct? Your actual rent was 72. But in this, the bad debt is 6,000, which means 66. This 66 will be compared with that 66, whichever is clear. Let's say this was 68. Government was expecting out of you 68. Government was expecting out of you 68. You genuinely were ready to pay 72. Genuinely ready to pay 72, but he did not pay you rent for 1 month, which means now your expected rent, actual rent is, in this case, GAV will be 68. GAV will be 68. Government comes and says, it is your botheration that he did not pay you rent. It is your botheration that he did not pay you rent. I do not care. I want my expected rent. If you had a problem, you take care of it. I will collect my whole 68. Vacancy loss is the only place where you can claim your own benefits. Unrealized rent, it will directly reduce from your actual rent. Only for ICI exams. In practical world, this 6,000 rupees will be reduced from GAV. Practical world, 6,000 will be reduced from GAV. Practical world. ICI exams, it is reduced from your actual rent. ICI feels they know better income tax than income tax itself. Okay? So they feel they work differently. So they wanted to reduce from actual rent. I don't know how the logic works. Technically speaking, if you notice, it would have been 72 minus 66. You would have got 72. Then you would have reduced 6,000 and you would have paid lesser. Yes or no? But ICI feels they know better, so they fail. No, boss. You reduce it directly from your actual rent, and then you pay me more money. ICI exam you will directly reduce it from your actual rent. Clear? Not clear? Clear? Yes. 2 concepts we discussed: vacancy loss, unrealized rent. When it comes to vacancy loss, you will check for expected rent minus actual rent for the whole year, and then you will check whether you are genuine or not. If you are genuine, claim the loss. Not genuine, ignore the loss. But when it comes to unrealized rent, directly reduce it from your actual rent before comparing your expected rent itself. Here also, income tax comes and says, no, boss, you can only reduce if you satisfy some conditions. They have given you 4 conditions. You don't have to mug it up. Logically think about it. You are going to end up in a bad debt. What will happen? First, you will go to him. Ask for money. You will ask for money. He did not give you money. What will you do? what will you do? You will ask him to vacate the property. You'll ask him to vacate the property. But if a person is like me, does not have a muscle and all, go to him and ask him to vacate the property. That guy is muscular. F4 file poite gym irukkaru. Will I go and tell him, boss, vacate the property? He'll vacate the property. Will he vacate the property? No. In that case, what will I do? What will I do? I will at least try to tell him to vacate the property. Okay? Which means either he should vacate the property or I should try to get him to vacate the property. Or I should try to get him to vacate the property. In English terms, we tell it as reasonable steps taken for vacating the property. Reasonable steps taken for vacating the property. Let's say for some reason he is okay to vacate the property. He's okay to vacate the property. He's already not paying you. He's already not paying you. You have already made him vacate the property because he's not paying you. Will you take him back? Will you take him back? No. Or will you tell him that, boss, I have another house, you go and live there, there also you don't pay me? Third scenario, they came and said, boss, if the person has vacated, please ensure that the person does not come and stay in another property. Please ensure that the other person does not stay in other property. 4 conditions to be satisfied. Condition number 1, first of all, tenant should be valid. Meaning, tenancy should be bona fide. It should not be your brother and sister. It should be an actual tenant. It should be an actual tenant. Tenancy should be bona fide. Second one, you should have taken reasonable steps for him to vacate the property, or he should have vacated the property, Scenario number 3, after he has vacated the property, you should ensure that he does not take another property. Whose property? Your own property. You should have not taken an other property. Fourth step is obviously you should have asked for collecting money. You should have asked for collecting the money. Money varla, property varla na gali pochu. In this scenario, you will treat it as a bad debt and you will claim it from your actual rent. If not, never claim it. Never claim it. Clear? Not clear? Clear? Sure? Yes. We are done with municipal taxes, fair rent, standard rent, actual rent. GAV is over. Came to municipal taxes, realized at NAV. In NAV, you have 2 kinds of deductions coming to you. One deduction is your standard deduction. Of 30%. One deduction is your standard deduction of 30% on your NAV. Next deduction is your interest on house property. Interest on loan taken for the purpose of your house property. 30%, I don't have to explain you anything. Comes your interest on loan. Provisions are coming and saying, boss, if you have taken a loan for your house property, first tell me whether the property is SOP or LOP. If it is an LOP property, whatever interest you pay is fully allowed as deduction. Question to you. My property is DLOP. Interest is fully allowed as deduction. The difference of you having in DLOP and SOP is only up to the stage of NAV. The moment you are done with NAV, DLOP becomes same as LOP. DLOP becomes the same as LOP. In this scenario, you will have the deduction of full. The full interest cost will be allowed as a deduction, provided it is an LOP property or a DLOP property. But if it is an SOP property, I will ask you to satisfy 4 conditions. 4 or 3? 3 conditions. I will ask you to satisfy 3 conditions. If you satisfy the 3 conditions, I will give you a deduction of 2 lakh rupees. You don't satisfy any one condition also, your deduction will be restricted to 30,000 rupees. Question to you. 2 lakh rupees per house per year. Per house per year. It is 2 lakh rupees per year. Meaning, if you have 2 SOPs, interest from first SOP is 2 lakhs, interest from second SOP is 2 lakhs, total becomes 2 lakhs only. The maximum interest which you can claim in a year is 2 lakhs. The 30,000 is only a restriction condition. Meaning. Let's say you have 2 properties. First property interest is 1,50,000. 1,50,000. All conditions satisfied. All condition satisfied. Second property, you have not satisfied the condition and you paid an interest of 60,000. You paid an interest of 60,000. Second property, what will happen? First, you will reduce it to 30. First, you will reduce it to 30, then add it to the 1,50,000 and then check for the 2 lakhs. Then check for the 2 lakhs. So 1,50,000 plus 30 will become 1,80,000. Maximum deduction you can claim is only the interest 1,80,000 na eppadi unakku 2 lakhs. 1,50,000 plus 30,000 is 1,80,000. Maximum interest you can claim is 1,80,000. Maximum interest you can claim is 1,80,000. So understand it is 2 lakh for the property which is condition satisfied, 30,000 for property where condition is not satisfied. But overall you can only claim. Overall you can only claim 2 lakhs. Second question. Is it 2 lakhs per person or 2 lakhs per house? 2 lakhs per owner or 2 lakhs per house? Huh? Per owner. It is 2 lakhs per owner. Meaning, if there are 2 owners of the property, interest you can claim on the property will become 4 lakhs. Interest on the property will become 4 lakhs. It is 2 lakhs per year per person. 2 lakhs per year per person. Which means if a property has more than one owner, then the interest also will become for both the owners. Interest will also become for both the owners. This is a concept called as co-ownership. What is the concept called as? Co-ownership. Co-ownership comes and says, boss, if you have a property who has more than one owners, 2 lakh will also be increased for every owner. 2 lakh will also be increased for every owner. And at any given point of time, whatever rents you have will be split between both the owners in the ratio of profit sharing. In the ratio of profit sharing. Whatever is your profit sharing ratio in that scenario is what you will claim. Correct or not? Yes, with this I'm done with the co-ownership concept also. Coming to the question, what are the 3 conditions? What are the 3 conditions? Condition number 1, you should have taken the loan after 1/4/1999, the year after I was born. The year after I was born. Yes, 1/4/1999. That's how I remember, ma. You take care of yourself. Yes, it was born. Want to know my age? I was born in 1998. Okay, I'm 24. Yes, the loan was taken in 1/4/1999. First rule. Which means if the loan is taken before 1999, interest will become 30,000. Interest will become 30,000. I have a property. I have given it to you for rent for 20,000 rupees. Given it to you for rent for 20,000 rupees. I have taken a loan on that property in 1987. And the interest on that property is 1,10,000 rupees. Interest on that property is 1,10,000 rupees. Deduction eligible to me is Question repeat one more. I have a property, given it to you for rent. Rent is 20,000 per month. Rent is 20,000 per month. And the property I've taken a loan. Loan was taken in 1997. Interest on that loan is 1,10,000 rupees. Interest allowable as deduction is? Why? Very good. Understand the property is LOP. Understand the property is LOP. Loan conditions are only for repeat panadana tapista. Yes, understand LOP has no conditions. LOP has no conditions. Anga portha varaikum whatever interest you have is fully allowed as deduction. Fully allowed as deduction. In an SOP property only, the loan should be taken after 1999. Here is where the loan has been taken before 1999. In that case also it is eligible because it is an LOP property. Changing the facts, if I was living in that property, the interest would have been 30,000 rupees. Condition number 1 is what? Loan taken after 1999. Loan taken after 1999. Condition number 2. Whatever loan you are taking should be only for the purpose of construction or acquisition. For the purpose of construction or acquisition. If you take the property for repairs, it will become 30,000. It will become 30,000. If you're taking for repairs, renovation and all, it becomes 30,000. Only you can take for construction and acquisition. Same question. I gave you a property for rent. If I give you a property for rent and I have taken a loan on that property, the loan is going to be used for renovation of second floor. Renovation of second floor. Interest on that is coming as 1,10,000. Amount eligible as deduction is full 1,10,000 because the property is LOP. If the property was SOP and I took the property for renovation of my second floor, this becomes clear. Yes. Third condition. Whenever you take the loan, the property should be completed within 5 years. From the date on which you complete your loan, from the date on which you take your loan, the property should be completed within a period of 5 years. The completion can be in the form of acquisition or in the form of construction. It doesn't matter. Okay, but from when you take the property, when you take the loan, the property should be completed within a period of 5 years. If it is not completed, you will get it 30,000. If not, you will get 2 lakhs. If not, you will get. It's clear. Yes. I have a loan. What do I have? I have a loan. I have taken the loan and I have to pay an interest of 10,000 on it every year. I have to pay interest of 10,000 on it every year. This loan is taken for the house property. The due date for the loan has come. And I need to repay it back. But I don't have money. What will I do? 2 options. Either I'll abscond or I'll take another loan. Assuming I'm a genuine person, I took another loan. So I took another loan. I went to SBI and I came and said, I have a loan from HDFC. So I will take this loan, pay this money in HDFC. The interest on the new loan is 12,000 rupees. Okay, let's make it 1,20,000. The interest on the new loan is 1,20,000 rupees. Question to you. Can I claim this 1,20,000? Yes or no? Yes or no? Why? No, why? நான் இன்ட்ரெஸ்ட் அடிக்காக பண்ணல, லோன் அடிக்காக பண்ணல. Yes. Am I eligible for deduction? Yes or no? Yes or no? Yes, I am eligible because understand the loan which you took initially was for the purchase of house property. This loan is just becoming a alternate to the first loan. In which case technically it be assumed that this loan is now for the purchase of the house property. Therefore it is eligible. Clear? Yes. Option number two. I have a loan. The interest on that loan is 10,000 rupees. And the loan I did not repay, because of which the bank came and said, now you have to pay me 12,000. Because I did not repay back the loan and the interest on time, bank is telling me, boss, now the interest becomes 12,000 rupees. What is this 2,000 rupees extra? Penalty. What is the 2,000 extra? Penalty. Question to you. Deduction eligible is 10,000 or 12,000? 10,000. The interest is only 10,000. 2,000 is penal in nature, will be disallowed for you. Or in substance will not be claimed as a deduction. Clear? Yes. Option number three. You are having a house property. This house property is in your name, so no loan. But you have a municipal tax on it. What do you have? Let's say this year's municipal tax has come as 2 lakh rupees. You don't have money to pay, so you took a loan to pay the municipal tax. You took a loan to pay municipal tax. 2 lakh rupees is taken, paid the municipal tax. Interest on that loan is 10,000 rupees. Amount eligible as deduction. Not allowed. Why? Very good. Loan should be for the purpose of the house. Not for the purpose of paying taxes. This loan will not be allowed as deduction. Municipal tax allowed as deduction is. Allowed, but you have paid it through loan, no? It is just paid. That's all. Okay, just because you paid through loan does not mean anything difference. It is still paid from your pocket. Therefore, it is allowed as deduction. Clear? Yes. This sums up the definition of interest. With your GAV getting over, NAV getting over, we have 2 kinds of things. One is 30% of NAV. One is interest. You will arrive at something called as income from house property. Here is where there are certain special scenarios for you. First special scenario is called as pre-construction interest. What? What the income tax comes and says is, boss, you are eligible for income from house property only from the date on which the house is ready. Yes or no? You will start computing IFHP only from the year in which the house is ready. What if you took a loan before the house is ready? And the interest cost is lost for you? Yes or no? Because claim pandradhukku onnume illa. In this scenario, income tax comes and says, boss, whatever is the interest which you have, whatever is the interest which you have. That full interest can be accumulated together and called as pre-construction interest. Can be accumulated together and called as pre-construction interest. This pre-construction interest, you can claim it over a period of 5 years, starting from the year of completion. Starting from the year of completion. Clear? Yes. Question to you. Here is my pen. Question to you. My property completed on 28th February 2022. 2023. My property completed on 20th February 2023. I took a loan on 1st April 2016. April 2016. What is my pre-construction period? 1/4/2016 to what is my pre-construction period? 31st March 2020. Understand, people. Pre-construction period is referred to as that period which is before the year in which your house is completed. Which means if the house was completed in this year, this full year is called as a completion year. This full year is called as a completion year. This year is when you can claim the full interest. You can claim the full interest. What you cannot claim is the past years. What you cannot claim is the past years. So only that past year becomes your pre-construction. This is where the most challenge is. People make a mistake here only. Most of the people will come and say it is 1/4/16 to 28th February 23. Right? Is this right? No. It is only till the last year. It is only till the last year. Pre-construction period means the FY prior to the FY in which the house is completed. Prior to the FY in which the house is completed. Clear? Not clear? Clear? Yes. Question. I took a loan 1st April 2022. I took a loan on 1st April 2022. My house was completed on 31st March 2022. 2023. My house was completed on 31st March 2023. My pre-construction period is. House is completed in the same. Yes or no? Yes or no? So the pre-construction period becomes. Clear? Yes. Yes. My house was completed on 1st August 2022. My house was completed on 1st August 2022. I took a loan on 1st September. August September. I took a loan on 1st September 22. My pre-construction period is. House completion. Date of loan. My pre-construction period is. I have taken a loan after my house was completed. Rahul, can you take a loan after your house is completed? Hey, repair pandradhukku who will take? After the house is completed only, no. Can you take a loan after the house is completed? Obviously, yes, because the loan could be for the purpose of renovation, repairs. Yes or no? Yes, sir. Definitely possible. Definitely possible. In this case, the pre-construction period will be not applicable. Clear? Clear? Sure? Yes, this is how your pre-construction period works out. What will you do is the pre-construction period of 1st April 16 to 31st March 22 will be accumulated and will be allowed over a period of 5 years, starting from previous year 20. Starting from the previous year 22-23 to the previous year 27-28. Question to you. My pre-construction period divided by 5. Totally my pre-construction period is 60 lakhs. How much? Divided by 5 is 12 lakhs. Divided by 5 is 12 lakhs. This is my pre-construction period. I should claim pre-construction interest. I should claim every year. Current year my interest is 80,000 rupees. How much? 80,000 rupees. Total deduction I can claim in the current year for an SOP property is. Current year I can claim SOP property interest of. Question Purilia. Question Purilia. You have a property now. You have a property. The property was completed on 28th Feb 23. The property was completed on 28th Feb 23, for which you took a loan in 1st April 16. You took a loan on 1st April 16. The total interest on the pre-construction period is 60 lakhs. You are going to allow it over a period of 5 years, starting from 22-23. Starting from 22-23. Current year, your interest cost is 80,000 rupees. Current year, your interest cost is 80,000 rupees. The total interest which you can claim on the house property, assuming this property was SOP, assuming this property was SOP, amount is, can I come and say, boss, 80,000 for the current year is subject to 2 lakhs and 12 lakhs I will fully be allowed as deduction? Understand, the 12 lakhs also forms part of your full year. The 12 lakh also forms part of your full year. I am not saying that the 12 lakhs is allowed as deduction. I am saying that 12 lakhs should be considered for the purpose of interest. Understand the difference? Understand the difference? 12 lakhs is not allowed as a deduction. It is considered for the purpose of interest. Current year interest becomes 80,000 plus 12 lakhs. Total is 12 lakh 80,000. Limit is 2 lakhs. Therefore, you can only claim. Clear? Clear? Yes. Assuming this property was DLOP. Full 12 lakh 80,000. Yes. This is how the pre-construction interest works. This is how the pre-construction interest works. With this, let's understand what do you mean by SOP, LOP and DLOP. In an SOP property, GAV will always be, NAV will always be. Yes or no? Yes. If the GAV itself is 0, if you claim municipal taxes, NAV will become negative. Department will never give you loss. Department will never give you loss. So NAV will become 0. 30% of NAV is, which means the only thing you can claim an interest on, can I say, SOP property will either have 0 or have a loss. True or false? True or false? True. If you have an interest on loan, it will become a loss. If you have no interest, it will become 0. So can I say for an SOP property, loss will range from 0 to 2 lakhs? Yes or no? Yes, sir. Can I say for an SOP property, loss will range from 0 to 2 lakhs? What is this 2 lakhs? Maximum interest. Maximum interest. You cannot go beyond 2 lakhs, no? Therefore, the maximum interest will be 0 to 2 lakhs. So, in substance, SOP property GAV is 0, NAV is 0, 30% of NAV is 0. Interest on loan is the only thing you can claim. Therefore, it will always be loss. It will always be loss. Correct or not? Yes, sir. When it comes to LOP property, whatever we discuss is what is the final. So, GAV will also come, NAV will also come, deductions will also come. When it comes to DLOP, do you have a municipal value? Yes. Do you have a fair rent? Yes. Do you have a standard rent? Yes. Which means, can you compute expected rent? Do you have an actual rent? In this scenario, what to do? GAV directly becomes expected. GAV directly becomes expected rent. Actual rent will be ignored. Actual rent will be ignored. GAV directly becomes expected rent. And after that, the step is same as LOP, meaning 30% of NAV and then full allowed of deduction. Full allowed of deduction, you will arrive at a income from house property for DLOP. Income from house property for your DLOP. Correct? Not correct? Next scenario. You have a house. You have a house. First floor is given for SOP. Second floor is given for LOP. What? First floor is given for SOP. Second floor is given for LOP. You have certain common items. Question to you. You have municipal value for the full property or for part of the property? Full property. What to do? Split basis. Floor area. Split basis. Floor area. So let's prepare the computation. What will happen? Municipal value split, no split. Split. Standard rent. Split. Fair rent. Actual rent. Actual rent is only for the LOP property. Actual rent is only for the LOP property. This will arrive at your GAV. Municipal tax split. Municipal tax will be split. NAV will come automatically. It will come automatically. 30% of NAV. Same, no? It will come only for LOP. It will come only for LOP because SOP is 0. Interest on loan. Very good. First split the interest basis your floor area. Then SOP part will be 2 lakhs. LOP will be full. Yes or no? Yes or no? Second option. You have a building. One building. 2 months it was SOP. 10 months it was LOP. 2 months it was SOP. 10 months it was LOP. What to do? The property is deemed as let out for the whole year. The property is deemed as let out for the whole year, and actual rent will be treated as actual rent for the whole year. Actual rent will be treated as actual rent for the whole year, meaning expected rent will be for 12 months. That will be compared with actual rent for your actual rent for 10 months. Rahul, will you incur losses in this? Yes, you don't have an option. Income tax comes and says you should have never treated the same property as both SOP and LOP. You should have never treated the same property as both SOP and LOP. If you have made the kind of mistake, what I will do? I will treat the full property as an LOP property, and I will assume that the rent which you received is for the whole year. Understand the difference between this and your vacancy loss. In this, you treated the property as an SOP. Which is why your actual rent is now assumed for the whole year. In that, you treated the property as an LOP. You were just not able to utilize it. In which case, your actual rent will be deemed to be for the, meaning in that you will compute for the whole year and then you will reduce your vacancy loss. In this, you will directly take your actual rent for the 10 months as the whole year thing. 10 months as the whole year. Clear? Not clear? Yes. Clear? Yes. This marks the end of your HP. I don't have anything further to discuss, but any doubts till now? No doubts? All clear? Yes. One thing probably which I missed out to let you know is when it comes to bad debts. Bad debts is recovered from your unrealized rent. Tomorrow if you receive it back. Let's say for example, you were supposed to receive 2 lakh rupees. How much? You were supposed to receive 2 lakh rupees. He did not pay you this money. So this 2 lakhs will be reduced from your actual rent. 3 years later, he came back and he gave the 2 lakh to you. He gave you back 2 lakhs to you. Income taxable is reverse the 2 lakhs. What is that?
These 2 lakhs is taxable.
I know it is taxable. Income taxable is very good. The income taxable is 2 lakhs minus 30%. I again told you it's not the receipt, I'm talking about the income. Income taxable is 2 lakh minus 30% because, very simple people, had you received the rent at that time itself, your NAV would have been reduced by 30%. Because you did not receive it, you lost 30% benefit. Yes or no? Yeah. They are giving you that benefit back. Again. To make it very simple to you, what I've done is in the format itself, if you notice, I have put it exactly before NAV. In the format itself, I would have put it exactly before NAV so that even if you forget, the format will take care of it. The format basically says what? You need to add it before your NAV. The moment you add it before your NAV, 30% will automatically come. Clear? Not clear? 100% clear? Great. I see some sleepy faces, so we'll go for a break and then we'll come back and do the sums. Okay, let's take a break. What is the time? 5:20. When do you want to come back? Who's the time? 5:45? Is 5:45 okay? Let's come back at 5:45. We started from what is called as annual value of an house property and we said it is taxable in HP. Then we came and said, boss, you have to be the owner of the property. What is an HP? How do you become an owner of the property? Subletting becomes taxable under other sources. Deemed ownership order concepts. Rent concept we discussed. Transfer of house property to spouse. Transfer of house property to minor child. Then we said what happens in a property. If it's an LOP property, it becomes directly taxable. SOP property, you have to split it into 2. Check for whether it is for more than 2 properties and it becomes DLOP. Less than 2 properties, it becomes SOP. In this case, we told boss if it is a stock in trade case, then what will happen? For the next 2 years, it will not be taxable. After that, it will become taxable. Then the whole format came into picture. What is a municipal value? What is fair rent? What is standard rent? And what is actual rent? Actual rent, Puerto Rico, unrealized rent will directly be reduced from your actual rent. But whenever there is a vacancy loss, you will check for the actual rent for the whole year. Then we spoke about municipal taxes. We told it should be actually paid and it should be paid by the owner. India le pay panalo eligible, foreign le pay panalo eligible. Then we discussed about interest on loan. We said that, boss, when it comes to LOP property, it is fully allowed as reduction. SOP property, what will happen? Check for 3 conditions. Condition satisfied, you will get 2 lakhs. Condition not satisfied, 30,000. But overall for the year, you will only get 2 lakhs. Overall for the year, you will only get 2 lakh rupees. Interest on fresh loan is also allowed as a reduction. But if you have taken any interest for penal nature, then it is not allowed as reduction. Any interest on municipal taxes is also not allowed as reduction. This is your pre-construction interest, where we clarified that pre-construction period is the year prior to the year in which your asset is ready. Asset is ready. Then we came and discussed what is unrealized rent, null order condition. Null order condition. And then we said, boss, whenever you realize your unrealized rent, you have to allow 30% as reduction. You'll have to allow 30% as reduction. Then we discussed what happens in a part SOP and part LOP. Ore property, 2 months it was SOP, balance months it was LOP. Full year it will become LOP, and actual rent will be for the full year. Actual rent will be for the full year. But whenever it comes to part LOP and part SOP in the form of floors, apportion whatever is possible and give it off. Actual rent will be the same. Actual rent will be the same. If the property is joint owned, what will happen? The 2 lakh rupees or the 30,000 rupees which you have will be per owner. Will become per owner. Composite rent is not relevant from exam perspective. Losses we will discuss when we come to set off chapter. Yes. In this, since we are also discussing 115 BSc, the only change in 115 BSc from your normal computation is SOP loss is 0. SOP loss is 0. Whenever you are in 115 BSc, interest on SOP loss will not be allowed as a reduction. Meaning SOP Puerto Rico, SOP will become fully 0. SOP will become fully 0. That is the one change in 115 BSc compared to normal. Okay, keep this in mind. I told you we are not going to discuss what is in 115 BSc. Correct? So 115 BSc Puerto Rico, whatever is the losses which you have will be not eligible for SOP property. Will not be eligible for SOP property. Will only be eligible for LOPs. Keeping that in mind, let's do the questions. Look at the question. You are Mr. Ganesh, who has a property with municipal value as 2,50,000. Your fair rent is given as 2 lakhs and the standard rent is given as 2,10,000. Yes, the property has been let out for a rent of 20,000 per month. However, the tenant had the property vacant for how many months? 2 months. It was vacated on 31st January. Therefore, it is vacant for 2 months. The unrealized rent on the property is 20,000 rupees and all conditions are satisfied. You are required to pay the municipal tax of 8% of municipal value. Interest is given as 3,80,000. You are required to compute the income from house property. How do you start? You will check for municipal and fair, whichever is higher. 2,50,000 versus 2 lakhs is 2,50,000. Compare with 2,10,000, whichever is. Therefore, 2,10,000. This 2,10,000 will be compared with your actual rent for the whole year minus unrealized rent. Ignoring the vacancy, your actual rent for the whole year is 20,000 into 12. Number is 2,40,000. But you have an unrealized rent of 20,000. So therefore, 2,20,000. Now 2,20,000 will be compared with 2,10,000, whichever is higher. Therefore, your actual rent is 2,20,000. Your GAV is 1,80,000 because you are now being found as a good citizen. You will be eligible for a vacancy loss. How much is your vacancy loss? 2 months. 2 months or a vacancy loss. 20,000 into 2 becomes 40,000. 1,80,000 will become the GAV. Clear? Not clear? Clear? Your GAV becomes 1,80,000. You have a municipal taxes of 8% of what? 8% of 2,50,000. 2,50,000 into 8% will give you 20,000. So 1,80,000 minus 20,000 becomes 1,60,000. In this you will reduce 30%, so 48,000, and you will reduce amount 2 lakhs or 30,000. 2 lakhs or 30,000. Yeah, I am responsible for telling wrong answers only. You will claim the full 3,80,000 because it is. Give me the final number. Minus. So the answer is minus 2,68,000. Done? Yes. Next. Srimati Rajalakshmi owns a property at Hariharan, Chennai. The municipal value of the property is given as 5 lakhs. Fair rent is given as 4 lakh 20. Standard rent is given as 4 lakh 80. Tell me what is the GAV? What is 4 lakh 80? Take the question first puri. Compute the GAV. Golden rule number 1. Sarima. What is your GAV? Your GAV is 4 lakh 80,000. Howda? Start with the top. Your municipal value is 5 lakhs compared with fair rent, whichever is higher. Therefore, 5 lakhs. Compare with standard rent, whichever is lower. Therefore, 4 lakh. Expected rent is 4 lakh 80. Hold there. Hold there. Now come to actual rent. The question says that the property was let out for 50,000 for December, which means 9 months. So 4 lakh 50,000. 4 lakh 50,000. Then it says thereafter the tenant vacated the property and Rajalakshmi used it for self-occupation. The moment you use the property for self-occupation, the property is deemed as a let out for the full year, which means actual rent becomes 4 lakh 50. Actual rent becomes 4 lakh 50, in which they are coming and saying that boss, she did not receive the rent for the month of November and December despite all the efforts. This is your unrealized rent. And then they come and say all the conditions are also satisfied, meaning 1 lakh rupees worth of rent you did not receive. So no. Therefore, you have only received actual rent of 3 lakh 50. Actual rent of 3 lakh 50. 3 lakh 50 versus 4 lakh 80 will give you the answers. Yes, sir. Any confusions? Na sonna matto da varma. 4 lakh 80 is the final answer, which is your GAV. 4 lakh 80 is your GAV. She paid municipal taxes at 12% during the year. What is the municipal tax amount? How? Understand, municipal tax is always on your municipal value. 12% of 5 lakhs will become 60,000. So therefore 4 lakh 80 minus 60,000 is 4 lakh 20,000. She paid interest of 25,000 during the year for amount borrowed for repairs of the house property. Amount allowed as deduction is full 25. Why? Because you can claim up to 30,000. Huh? You can claim anything. Because the property is treated as an LOP. Fortunately, the interest is only 25. It is 25,000 for an interest. Next crash course, I will make it 2 lakh 50. Next crash course, I will make it 2 lakh 50. Your choice whether you want to come for it or not. Yeah. Yes. The interest is 25,000. Yes. So what was happened? 4 lakh 80 was your GAV. 4 lakh 80 was your GAV. 60,000 reduced as municipal taxes. 4 lakh 20 is your NAV. 4 lakh 20 is your NAV. Reduce 30%. Number is 1 lakh 26,000. Reduce interest. Number is 25,000. Get me the final answer. 2 lakh 16. Doubting at the final answer does not make sense when you don't get the first answer right. Mr. Raman is a co-owner. Mr. Raman is a co-owner of the house property along with his brother holding equal share. We are into co-ownerships. They say that the municipal value of the property is 1 lakh 60, fair rent is 1 lakh 50, standard rent is 1 lakh 70. Rent received during the year is 15,000 per month. Give me the expected rent. Give me the expected rent. 1 lakh 50,000. Your expected rent stands at 1 lakh 60,000. The loan for the construction of the property is jointly taken and the interest charged by the bank is 25,000, out of which 21,000 has been paid. Amount of interest allowable as reduction is. The total interest is 25,000, you paid 21,000. Amount of interest allowable as reduction is. Two options, 25 or 21. Full 25,000. Full 25,000. The only condition for payment is on municipal tax. The only condition for payment is on municipal tax. No condition is lying for loans. Therefore, it is full 25,000. Full 25,000. Interest on unpaid interest is 450. Not allowed. To repay this loan, Raman and his brother has taken a fresh loan and interest charged on that is 5,000 rupees. Allowed, not allowed? Allowed. Municipal taxes of 5,100 has been paid by tenant. Not allowed. Paid by tenant. Be very careful about what the question says. It's paid by tenant, therefore it is not allowed. Interest charge is 5,000. Other interest charge is 25,000. Total interest charge is 30,000 rupees. Amount allowable as reduction is. Interest amount allowable as reduction is by. Because it's LOP property. Because it is LOP property, it is fully allowed as reduction. 30,000 is the answer. Get me the GAV. 15,000 into 12 is 1,80,000. 1,80,000 versus 1,60,000 will become 1,80,000. 1,80,000 is your GAV, guys. 1,80,000 is your GAV. Minus municipal taxes 0. Therefore, GAV becomes 1,80,000. Reduce 30%. Number is 54,000. Correct? 18 into 3 is 54 only, no? Yes, sir? Yes. 30%. Interest is 30,000. Therefore, it will become 96,000. Done? Yes. Next one. Two brothers, Arun and Bimal, are co-owners of a house property with equal share. The property was constructed during the financial year 98-99. The property consists of 8 identical units and is situated at Cochin. There is a property. There is a property. 8 acha. 8. There are 8 units in that property. Co-owned by Amal and Arun and Bimal. Co-owned by Arun and Bimal. Property was completed in 98-99. What is the significance? No significance. Property is completed. Loan is not. No significance. During the financial year 22-23, each co-owner occupied 1 unit of the resident and the balance 6 were let out. So one is occupied by Arun, one is occupied by Bimal. This becomes fully LOP. Which year? Your year. 22-23. 22-23, 6 properties are SOP, LOPs, 2 properties are SOP. Yes. They each were let out for a rent of 12,000 per month. Per unit. Okay. The municipal value of the total property is given as 9 lakh rupees. And the municipal tax is at 20% of municipal value. Abdina enna artham?
Municipal value of the rental property is
the municipal value is given as 9 lakh rupees and the municipal tax is at 20% of municipal value. How much is your municipal tax? 1,80,000. As of now, 1,80,000. Which were paid during the year. Okay. Other expenses during the year as follows: repairs, insurance premium, interest payable on loan for construction of house, a maximum amount. It is not just let out, there is SOP also. To that extent, you will have to break it out. One of the let out units remained vacant for 4 months during the year. Of the 6 properties length, 1 unit was let out for 4 months. Was vacant for 4 months. Arun could not occupy his unit for 6 months as he was transferred to Chennai. He does not own any other house. Relevant, not relevant? It was an SOP for him anyways. The other income of Arun and Bimal are given at 2,90,000 and 1,80,000. You are required to compute the income from the house property and the total income of both the brothers. Okay, let's first understand the income from house property, then we'll distribute it between the brothers. Starting from the house property, you have SOP also, you have LOP also. SOP how many units? LOP how many units? 6 units. SOP order municipal value is?
okay, 6 lakhs.
No, wait, she's computing. What is the value? Huh? என்ன கேட்டேன் நானு? What did I ask? SOP order? What is SOP municipal value? Confident சொல்றேன் பாரு. What is the SOP municipal value? 0. What is the LOP municipal value? 9 lakhs into 6 by 8. Number is 6 lakh 75,000. Yes or no? Have they given you fair rent? Have they given you standard rent? Question is wrong. Can we go to the next question? Incomplete information. Bro. Assume this as ER. Assume this as ER. Coming to AR. SOP AR is SOP AR is 0. LOP AR is 3 lakh. How did you get it? 12,000 into 6 into 12, correct?
Yes, sir.
12,000 into 6 to 12 number is 8 lakh 64,000. 8 lakh 64,000. Therefore, your GAV is. Acha. Very smart. LOP. You have a 4 months vacancy. Be careful on the question you read. You have a 4 months vacancy in one of the unit. You have a 4 months vacancy in one of the unit, which means now you need to check whether you are a good citizen or a bad citizen. As such, you are a good citizen, which means you will reduce 48,000. 48,000 is nothing but 12,000 into 4 units. Number is. Okay, correct. Yes, 8,16,000 becomes your GAV. From that, you will reduce empty. Empty for SOP is empty. Empty for SOP is empty. Coming to LOP, it is 9 lakhs into 20% into 6 by 8. 1 lakh 35,000. Get me the final value. 8 lakh 16 minus 1 lakh 35. 6 lakh 81,000. This is your NAV. In this, you will reduce 30%. Number is 204,300. Reduce interest on loan. Here is where you will have to stop. Here is where you will have to stop. You have an interest on loan of 3 lakh rupees. Has to be first split between SOP and LOP. Come to SOP. How much is the number? Into 2 by 8. 75,000. What is this interest for? When was the property completed? When would have the loan been taken? When would have the loan be taken? Before. Which means interest allowable as deduction is. Interest allowable as deduction is. Interest allowable as deduction is 60,000. By pa 30,000 per owner. 30,000 per owner totally becomes 60,000 rupees. This is the reason why I generally prefer people doing co-ownership at the stage of NAV itself. The moment it comes to NAV, there it's a split off. There it's a split off. The moment you split off between each owner, you'll automatically get the right answer. I always prefer students doing it. Split off from NAV itself. Split off from NAV itself, you'll have the correct answer always. If you choose you can understand this, then it's okay. If you choose you can understand this, then it's okay. My preference, let's start from NAV itself. My preference, let's start from NAV itself. You know NAV. Let's split it between both the persons in the ratio of 50-50. In the ratio of 50-50, Arun and Bimal. NAV for Arun will become 3,40,500. For Bimal, it will become 3,40,500. Now give the 30%. 1,02,150. Correct?
Yes, sir.
1,02,150. In this, you will allow interest on loan in two splits. One split is called SOP, one split is called LOP. In SOP, now you will be extremely clear that you have to give 30 each. Okay, so be extra careful. Co-ownerships, my preference, always split at the stage of NAV. Always split at the age of NAV. So therefore, you'll reduce 30,000 for SOP. Left of interest is how much? 3 lakh minus 75,000, 2 lakh 25,000. 2 lakh 25,000 fully eligible. Yes or no?
Yes.
Fully eligible for whom?
For both.
Number is 1,
1, 2,
1, 2.
5. Sir, 1, 1. Double
1 lakh 12,000. Anyone thinking why should it not be 2 lakh 25 each? Correct. So it is 1 lakh 12,500. Get the number.
$95.
95, 850, right side. Someone still calculating? Number one. Yes, it is 95, 850 for Arun, 95, 850 for Bimal, but this is your HP income. The question is asking you for total income of both the brothers, so add their other sources. They say Arun is having 2,90,000 and Bimal is having 1,80,000. Total it up. Lakhs up. 3,85,850. 2,75,000. Tax on both is wonderful. For those people taking your calculator, bye ma. Tax on both is 0. Why? Tax on both is 0 because of clear. Last question. Mr. Ganesh has 3 houses, all of which are self-occupied. Ganesh has 3 houses, all of which are self-occupied. The particulars of the houses are given to you as under. Okay, there is house 1, house 2, house 3. House 1 is the municipal value of 3 lakhs, 3 lakh 60, 3 lakh 30. Fair rent is given as 3 lakh 75, 2 lakh 75 and 3 lakh 80. Standard rent is given as 3 lakh 50, 3 lakh 70 and 3 lakh 75. Date of completion of the house property for the first one is 31st March 1999, which means okay, so yes, next one is 31st March 2001. You have taken a loan. The interest which you are going to pay is pertaining to repairs. The interest which you are going to pay is pertaining to repairs. Right side is 1st April 2014. You have taken an interest for the purpose of purchase. Money was borrowed in July 2015. You completed the property in 2014. Property was completed in 14. Loan was taken in 15, which means it is post. Therefore, it is fully eligible for 2 lakh rupees. It is fully eligible for 2 lakh rupees. You have been given 3 SOPs. Can you have 3 SOPs? Compute the Ganesh's income for the house property for 23-24, suggesting which house should be treated as DLOPs. Which house should be treated as DLOPs and which house should be treated as yes or no? Can we do it together? Let's do it together. Let's do it together. Yes. What is step number 1? Let's try to see what will happen if you treat the property as SOPs. What will happen if all the properties are treated as SOPs? Step number 2, what we'll do? Let's assume every property is LOP. What will happen? Okay, so we're trying to put a permutation. So step number 1, assuming all properties are SOP. You have house 1, house 2, house 3. If all the properties are SOP, GAV becomes 0 NAV becomes 0. 30% of NAV becomes 0, which means the only thing eligible is interest on loan. With that, let's understand. On the first one, interest is 0. On the first one, interest is 0. On the second one, interest is 30,000. Why? Property is taken for repairs. Third scenario, 1,75,000. Okay. Individually, if the property was an SOP, H1 would have been given 0, H2 would have given you a loss of 30,000, and H3 would have given you a loss of 1,75,000. Yes or no? Yes. Following you. Step number 2. Step number 2. What if you treat all the properties as LOP? What if you treat all the properties as LOP? Come to house number 1. Come to house number 1. Your municipal value is given as 3 lakhs. Fair rent is given as 3,75,000. Standard rent is given as 3,50,000. Whichever is. What is the expected rent? 3,50,000 for case 1. For case 2. 3,60,000. For case 3. 3,75,000. So 3,50,000, 3,60,000 and 3,75,000. 3,50,000, 3,60,000, 3,75,000. This is your expected rent. But in an SOP property, DLOP properties, your actual rent is 0. Therefore, this is also your GAV. Yes or no? This is also your GAV. Do you have a municipal tax in the question? Yes, sir. Give me the empties. House 1, huh? House 1 is 36,000. House 2 is 28,800. House 3 is 190. You don't have the question bank, huh? Question bank, Ilya. 19,800. Ask Hari, sir. He'll get a print for you tomorrow. Okay. 19,800 rupees. This will become your NAVs. Total is 2,99,000. 3,31,200. 75 and the 20 remove on every down. 3,55,200. 3,55,200. From this, you need to reduce 30%. Number. 30% numbers. 94,200. Second one. Hey, soft copy irukala unkita. Soft copy irukka. illa veetla poitu practice pandradhukku irukka ketta. 99,360. Next one. 1,06,560. Reduce interest on loan. If my memory serves right, interest on loan first one is 0. Second one is 55,000 and third one is 1,75,000. Give me the income from HPs. 2 lakh. Okay. Third one, huh? Okay, second one. 1 lakh. 840. Great. If you treat your H1 as in a DLOP property, you will get an income of 2,19,800. If you treat your H2 as a DLOP, you will get 1,76,840. And if you treat your H3 as a DLOP, it will become 73,640. Having this in mind, we now need to figure out which property should become DLOP and which property should become SOP. Which property should become SOP. So step number 3 is analysis. Step number 3 is analysis. Students of my batch will be quiet here. If you know the answer. If you don't know the answer, that's it. Okay. What is going to happen is we are going to do an analysis where we are going to understand what happens if we take one property as SOP and one property as DLOP and balance properties as SOP. So what I'm going to do, if the DLOP property is option 1, H1, option 2, H2, option 3, H3. Meaning, in the first column, I will treat H1 as DLOP and H2 and H3 as SOP. In option column number 2, I will treat DLOP as H2 and SOP as H1 and H3. In the third column, I will treat H3 as DLOP and H1, H2 becomes SOP. How do you figure it out? IFHP of H1, H2, H3. If I'm going to treat H1 as DLOP, this answer will come from step 2 or step 1 now. My H1 is DLOP. I want to know what is my income of H1. It will be from step 2 or step 1 now. Step 2. So this will come from step 2. This will come from step 1. This will come from step 1. Correct? In this one, it will be step 1, step 2, step 1. Yes or no? This will be step 1, step 1, step 3. Yes? Yes? Fill the numbers. Fill the numbers. You can see, no? On the top is your SOP numbers, on the below is your LOP numbers. Fill the numbers. Let's start from the last column. I want to feel like starting from the last column. Okay. So I'm starting from the last column. H3 is where you have an DLOP. So H3 order income will become 73,640. Correct? H2 will become from step 1. Number is 30,000. Yes or no? H1 will come from step 1. Number is 0. Done? You understand how to do? Let's work with this. Final answer of this is 43,640. Yes. Let's come to the second column. Your H2 is going to be DLOP. So H2 will become 1,76,840. Is screen clear? H2 will become 1,76,840. H1 will come from step 1, so it is 0. H3 will come from step 1, so therefore 1,75,000. Total will become 1,840. 1,840. Come to the first column. Your H1 is coming from second step, which means 2,19,800. Your H2 is coming from step 1. Number is 30,000. Your H3 is coming from step 1. Number is 1,75,000. Correct? 1 lakh. Answer any kariye.
H2 should be here.
I know the final answer. What is this green color? Why is it not 1,75,000?
Because 2 lakh.
A person can at best claim a maximum interest on SOP of 2 lakh rupees. Total your losses, it becomes 30,000 plus 1,75,000 is lakh. You can only claim 2 lakhs. In that 2 lakhs, 30,000 is already utilized. Left off is only 1,70,000. Yes or no? Purida.
Yes, sir.
Yes. Tricky adjustment for exam. The trick adjustment for exam. If you are not smart enough, if you are not cautious enough, this will go for a toss. Okay, be clear on this. Total comes to 19,800. Keeping this in mind, will you want to offer more income and more tax, or will you want to offer less income and less tax? You will choose.
House to S.
House to us. DLOP. Clear? Yes.
Yes.
Yes. This is what the provisions are. Any doubts?
No, sir.
This marks the end of your HP chapter. This marks the end of your HP. I can tell you one thing for sure, people. Since I'm standing here and doing it along with you, it somehow feels easy. Somehow feels easy. Things will go very different when you go home and do it. Okay. So the answer is just because you're coming to the class and you feel like you're confident enough, it doesn't work like that. Okay. Go home and still start practicing these things on your own. That is the only specific reason I'm not expecting you people to write in my class. I'm giving you all the only final answers just for your verification purposes. வீட்டு போயிட்டு practice பண்ணிட்டு தப்பா வந்தாதான் உனக்கு தெரியும். Okay, go home, make those kind of mistakes. Make those kind of mistakes, learn from your mistakes. Keep your different color pen always ready. Keep your different color pen always ready. This book is for you to scribble only. Okay, உன்னோட இருக்க book you have created specially for ஒரு fast track புதுசா book ready பண்ணி வச்சிருக்கீங்களா? It is only for fast track purposes. Scribble as much as you want. Okay, at the end of the day, when you complete this fast track book, you should have that kind of clarity that this mistake will not happen ever in my life. Okay? Whether it is inter or finals or after you qualify also. Okay, should never happen mistake again. Mistakes like making a mistake on standard deduction not given, rebate not being eligible, and all is a sin. Definitely not happening. Okay, it would have definitely not happened if you would have prepared yesterday. நேத்து கரெக்டா பண்ணிருப்பீங்க, வீட்டு போயிட்டு பிராக்டிஸ் பண்ணிட்டு அந்த மார்க் பண்ணிருப்பீங்கன்னா இந்த மிஸ்டேக் ஆயிருக்கவே ஆகும். Okay, I think there is a lack of practice. Please do start practicing. One of the whole intention of giving a crash course itself is out of the picture. It's not for me to come and play jokes around with you. You come and laugh in front of me. We can all laugh after we pass. Because if you don't pass, I will only laugh. You will not. Okay, let's not be the only person to laugh. I want both of us to laugh. So no, you laugh at me, I will laugh at you. Okay, let's not make it the fact that I will only laugh at you and then some uncle auntie on the backside also coming and saying, boss, let's laugh at this person because he did not pass. Not the answer. Okay, we need to laugh at them. They don't need to laugh at us. We have enough felt sorry for ourselves already. Yes, let's work with that. Clear? Yes, we're done with the chapter called as HP. I see we have only half an hour, so I don't think we'll be able to complete a target for salaries. So I'm holding off on salaries. We are going to start with the most easiest topic for the chapter called as okay. If you feel IFOS is easy, good for you. We are going to start with the chapter called as income from other sources. We're going to start from the chapter called as income from other sources. Supposed to be easy, but technically it is not. Supposed to be easy, it's technically not. The only reason it is easy is because it is small. That's all. The only reason it is easy is because it is small. Otherwise, it is never easy. Okay? Because the problem which happens is people generally say, boss, IFOS gift not taxable. But the answer does not lie in the gift not taxable. The intention is that the moment the gift is not taxable, somewhere silently clubbing is coming into picture. பார்த்திருக்கீங்களா? A simple example where you have given a property to your wife. You have given a property to your wife for gift. IFOS income is zero. IFOS income is zero. But if that property is used for the purpose of getting any kind of rent, that rent will become taxable in the hands of original owner because clubbing has come into picture. Because clubbing has come into picture, income tax plays very silently. Income tax plays very silently. It is not just enough for you to understand that IFOS is not taxable. It is also important for you to understand whether clubbing will apply or not. So work on those lines. Work on those lines. This is the whole intention which we are having when we are starting the chapter called as income from other sources. Let's go to the chapter. If things work out properly, next class we'll be doing salaries along with capital gains. If things work out properly, next class we'll be doing salaries along with capital gains. Adukku next class we'll be completing PGB. Okay? Maybe PGBP will take the whole day. Maybe. Hey, which is easy, salaries or PGBP? Which is easy, salaries or PGBP? Salaries is tougher. Exam பொறுத்த வரைக்கும் PGBP there are only 5 adjustments with income. ICI knows. அது அஞ்சு adjustment தான் இருக்கு. That 5 adjustments will keep coming for 50 years. அந்த 5 adjustment மட்டும் தெரிஞ்சா போறது அவ்வளவு. Shall we? Get into the chapter called as IFOS. In my book, IFOS is split into 2 chapters. In my book, IFOS is split into 2 chapters. One is called as IFOS. The other one is called as dividends. I've split it into 2 chapters. In your study material, you'll find it as a single chapter. In your other faculties materials also, you might find it as a single chapter. For my sake and benefit, I always split it into 2 chapters because it's easier to understand that way. Anyway, coming to that. Sir, could you say the 1,70,000 adjustment again, please? Boss, understand that whenever you have a SOP property, you can only claim a maximum deduction of 2 lakh rupees. If you notice in that question, what would happen is the interest would have been shown as 30,000 for the house 2. And for house 3, it is 1,75,000. Totaling it up to, it comes to 2,05,000, which cannot be accepted because you can only claim 2 lakhs. That is why I'm restricting it to 1,70,000. Okay. Yes, starting with a chapter called as IFOS income. Every chapter starts with a charging section. This chapter starts with the dustbin charging section. It comes and says, if nothing is taxable in other heads, you come and tax it in this head. That is what the charging section says. The charging section simply comes and says, if nothing is taxable in any other heads, you come and tax it in this head. Question to you. A parliament member has received a salary taxable under the head. Yes. A partnership firm partner has received a salary taxable under the head. You have received dividends from shares. You have received dividends from shares. You are a trader in shares. Still IFOS. Why? Understand, as a share trader, your intention is to sell the shares or hold dividends. Rakesh Jhunjhunwala or Harshad Mehta has become rich by getting dividends or by selling shares. For them, business is to sell shares or get that 10 rupees worth of dividend every year. You earn money from more dividends or sharing shares. Your business is to sell shares or earn dividends, which means PGBP will only be to the extent of you selling the shares. Dividend is only ancillary. That becomes clear, not clear. Clear? Yes. You have a house property. In that house property, you also have furniture. You also have TV. You gave the full house property to someone for rent. You are not able to separate the rent between furniture, TV and the house. In this case, income will be taxable under the head. Question Purilia. You have a house. In that house, you have a small TV, you have a furniture, you have AC. Okay. Basically, you gave a furnished house to someone. What did you do? You gave a furnished house to someone. The total house rent is 2,50,000. 2,50,000. Tenant came to you and said, sir, you give me a split. You tell me how much is the house worth and how much is the AC worth, how much is the fridge worth. You said, I don't know the split. I want only 2,50,000 rupees. This 2,50,000 will become taxable under the head. Why? Slump up. Hi.
House property that actually gives only
Very good. In house property, the charging section comes and says what can be taxed under HP is only annual value of the house property, which means you cannot tax for these items. You cannot tax for these items. That is where the concept of HP comes in. Now uses the word called composite rent. It uses the word composite rent. This provision comes and says if you are able to split the rent, HP rent you put it under HP, balance you put it under other sources. But if you are not able to split the rent, take everything and put it under. Take everything and put it under other sources. Clear? Not clear? Clear? Yes. Yes. You have received interest on employer contribution to PF. Taxable under the head. You have received interest on employer contribution to PF. Employer. ஏமா குடுக்கிறது காசு எனக்கு அவனுக்கு எதுக்கு டாக்ஸ்? Taxable under the head. Okay. Interest on employee contribution to PF. Employee contribution is IFOS. Employer contribution is salaries. Employer contribution to PF goes under salaries. Employee contribution sticks to other sources. Clear? Clear? Yes. You have had a compulsory acquisition. You have had a compulsory acquisition. This compulsory acquisition, you went and you filed a case. You went and you filed a case asking for enhanced compensation. Enhanced compensation money which you received will be taxable under the head. CG. Enhanced compensation will be taxable under the head. CG. Interest on enhanced compensation will be taxable under the head. IFOS. How much will be taxable? How much will be taxable? Only 50% will be taxable. Okay. Let's now jump to the subject. We are into the IFOS chapter. There are only certain items to remember. First item to remember is called your interest on enhanced compensation. Provisions come and say this is taxable only in the year in which you receive the interest. Because it is given by, you don't know when it will come. So it is only taxable in the year in which it is received. Therefore, it is taxable only in the year in which it is received. And income tax comes and says you can claim a flat deduction of 50%. You claim a flat deduction of 50%. No other expense can be claimed as a deduction. First adjustment. Second adjustment. If you have forfeited any kind of advance money, for what? For buying your capital asset. If you had a capital asset, you tried to sell it to someone. That person initially gave you a token money. Later on did not honor the contract. You forfeited his advance and kept it with yourself. Income tax comes and says, check whether the advance forfeiture is happening before 2014 or after 2014. If it is happening before 2014, it will be taken to capital gains and reduced from your cost of acquisition. If it is happening after 2014, it is directly taxable under the head. In the year. What is this? In the year, it is forfeited. Yes. Third, you have something called as post office savings. Income tax comes and says, if there is any kind of interest which you receive on post office savings, you will get a flat exemption of 3,500 today itself. Under the head IFOS. Apart from that, you can also claim 10,000 rupees under Chapter 6. Apart from that, you can also claim 10,000 under Chapter 6. If you receive any kind of interest on savings account, it is taxable under the head IFOS. Can you claim any exemption? No. Can you claim a deduction? Yes. Deduction is of 10,000 rupees under Chapter 6. Yes or no? Yes. Next, you have something called as family pension. Family pension, basically they come and say, boss, if you have received any kind of family pension. 1/3 of it or 15,000, whichever is lower, is allowed as an deduction. Okay, so what have we covered? We have covered interest on enhanced compensation, interest on savings account, advance forfeiture after 2014, then family pension. This is what we covered. Yes, this is what is the part of your charging section. Now we get into the two most important things under IFOS. One is called as premium on issue of shares. The other is called as gift. First provision is premium on issue of shares. Provision basically comes and says, if there is a closely held company, what? Abhinav? Private company. If there is a private company which issues shares at a premium, and the shares are given to a resident person. It is given to a resident person. Please ensure that the premium along with the face value does not go beyond the fair market value of the share. Please ensure it does not go beyond the fair market value of the share. If it goes beyond the fair market value, whatever excess you have received will be taxable in the hands of the company as IFOS. Just in case you did not understand, the scenario will work like this. Let's say, for example, the face value of the share is 10 rupees. You have decided to issue the share at a price of 60. Your premium on this is 50 rupees. You have decided to sell it at 60 rupees. Income tax comes and says, go and check the fair market value of this share. If the fair market value is found as 80 rupees, have you sold it more than fair market value, less than fair market value? Which means you have not earned a profit, yes or no? In this, IFOS will be zero. Fair market value was 50. In this case, your market value is 50. You sold it for 60. You got a profit of taxable under the head. Amount is 10 rupees. Fair market value is 8 rupees. Amount taxable is full 52 rupees. Your face value is 10. You issued this at the price of 8. Your fair market value is only 4 rupees. IFOS income taxable is by. You are supposed to issue the shares at a premium. You issued it at a discount. IFOS income will not apply. Your face value was 10. Your IP is also 10. Fair market value is 4. IFOS income is 0. You issued the shares at a par. You are supposed to issue it at. Rules are very simple. You should be a private company, should issue shares at a premium, should issue it to resident person, and your money should be more than your fair market value. Condition satisfied, the difference between the issue price and the fair market value will become clear. Any doubts? Marks the end of your first provision. We are coming to the next and the most important thing from exam perspective is your gift. Coming to the gift part of the provisions. In gift part of the provisions, they are first coming in clarifying. Boss, this should not be a gift from your employer. If it is a gift from your employer, it is taxable under the head salaries. It should not be a gift under business. If it is gift under business, it is taxable under PGBP. It should not be a gift received as stock in trade. If it is received as stock in trade, it will be taxable under PGBP. Which means I can only receive the gift in the form of a capital asset. Rule number one. With this rule setup, you now need to understand what are the type of assets. You have? How many other type of gifts you can get under IFOS? You can get how many types? You can get three types of gift. You can get three types of gift. Type number one is money. Type number one is money. Type number two is specified movable property. Type number two is specified movable property. Type number three is immovable property. Type number three is immovable property. What do you mean by money? They're coming and saying, boss, if you receive money more than 50,000 during the year, full amount is taxable. 50,000, full amount is taxable. Friend 1 gave you 10,000. Friend 2 gave you 15,000. Friend 3 gave you 65,000. Mother gave you 20,000. You want me to put mother 1? Mother gave you 20,000. Total 85, 1 lakh, 1 lakh, 10,000. Yes, sir. Amount taxable under IFOS is amount taxable under IFOS is 1 lakh. Amount taxable under IFOS is 90,000. Yeah, ma. Any gift from your own relatives are not taxable under the head IFOS. 90,000 is what you will tax it. Question to you. Can I come and say, boss, I should receive 50,000 per person, or is it 50,000 from any person? Total. It is 50,000 total. Totally during the year, if you receive more than 50,000 rupees, fully taxable. It does not matter even if it is 10,000 from one person. Okay, you will tax the whole thing. It is 50,000 received by you during the year. 50,000 received by you during the year. Clear? Yes. This is money. This is money. Coming to the next thing called as specified movable property. For you to start with the specified movable property, you need to first understand what is a specified movable property. In my class, I have this term to use as it is called as BA pass DJ. What do you mean by B? B is called bullions. A is called as archaeological collections. P is called as paintings. A is called as work of art. Any work of art. Any work of art. S is called as shares. S is called as sculptures. D is called as drawings. Drawings, no? Art. What is paintings? Paints. Pencil kircha, the drawing. You decide. J is DA pass teaching. Okay. Second is shares and sculptures. Okay. These are your BA pass teaching. Meaning. Either tavara, if you receive anything else, it will become not taxable. Either tavara, if you receive anything else, it will become non-taxable. One of the most famous questions for ICI is to come and ask sale of car, sale of mobile, sale of refrigerator, sale of TV. All these are called as personal effect assets. All these are called as personal effect assets. These are some of the most famous items which ICI generally keeps testing you. All these items are taxable, not taxable? Not taxable. Only these items are taxable. Only these items are taxable. Coming to your specified movable properties, income tax comes and says, boss, income tax comes and says, first is split into two. Understand, have you received any consideration for it or not received any consideration for it? If you have received a consideration, there should not be a inadequate consideration. Let's take a scenario where you have received no consideration. You received no consideration, meaning you gave shares today. You gave shares today. For the other person, I will come and check the fair market value of the share. I will come and check the fair market value of the share. If the fair market of the share goes beyond 50,000 rupees, the FMV will become fully taxable. The FMV will become fully taxable. Question to you. I gave him one share worth 20,000 rupees. I gave him one jewelry worth 10,000 rupees. I gave him a car of 4 lakh rupees. I gave him drawings of 50,000 rupees. I gave him a drawing of 50,000 rupees. Income taxable is Income taxable is by same logic as money. Same logic as money. It is FMV for all the assets together. FMV for all the assets together. It's not individual assets. It's all the assets together. So if the FMV of all the assets together has a consideration less than, more than 50,000 rupees, income fully will become taxable. Income fully will become taxable. Question to you: is taxable amount 80,000 or 30,000? Is 50,000 to be reduced and balance 30,000 to be taxed, or full 80,000? Full 80,000 is taxable. Option number 2. I gave him some consideration. But it is not adequate. It is not adequate. This is called as inadequate consideration. If the share was worth 20,000, I gave him 40,000. I gave him 5,000. I gave him 5,000. In this case, FMV consideration gift element is 15,000. Gift element is 15,000. Jewelry, 10,000 was the FMV. I gave him 15,000. I gave him 15,000. Can I say I paid him more 5,000? So therefore, I will set it off against my shares. Can I say that? No. Which means now your shares are showing gift element of 15,000. Your drawings is showing a gift element of 50,000. Add both, it becomes 65,000. Income taxable is 65. Clear? Yes. Yes. This is what is the provision when it comes to specified movable properties. Coming to immovable properties. Immovable properties have two considerations. One is either it is nil consideration or it is inadequate consideration. In this you will check for. There you check for FMV. Here you will check for. You know the answer. You are just not confident. SDV. Here you will check for SDV. SDV full form is stamp duty value. You will check for stamp duty value. If the stamp duty value of the property goes beyond 50,000 rupees, it will become taxable. It will become taxable. I gave him one immovable property of 40,000. Immovable property 2 of 60,000. Immovable property 3 of 10 lakhs. None of them I collected consideration. Income taxable under the head other sources is. Income taxable under the head other sources is 10 lakh 60. Income taxable under the head other sources is 10 lakh 60. Immovable property porthavarikko, it is individual asset. Immovable property porthavarikko, it is individual asset. When it comes to money, it is for you for the whole year. When it comes to specified movable, it is all assets for the whole year. When it comes to immovable, it is per asset. For immovable, it is per asset. Per asset is what I will check for 50,000 limit. First scenario did not cross. Second and third scenario cross. Therefore, second and third scenario is what I will consider. Clear? Not clear? Yes. If you have an inadequate consideration, income tax comes and asks you for 2 checks. Check number 1. Check if the consideration is less than 110% of the, check if the stamp duty value is less than 110% of the consideration. Meaning, if the consideration is 1 lakh rupees, stamp duty value should be at least 1.1. If it is at best 1.1, it means there is no gift element. Tax will be 0. If it goes to 1.2 lakhs, in that scenario, they will come and say, no boss, there is a gift. Question to you. In this case, gift will be 1 lakh to 1.2 lakhs or 1.1 lakhs to 1.2 lakhs. It will be from 1 lakh. Understand, the 10% is only a checkpoint. 110% of the consideration check பண்றதுக்கு தான் இருக்கு. If you check and you fall within the limits, no tax. If you check and you don't follow within the limits, you go back to your original thing. In that scenario, your gift will become 20,000. Here is where you do the second check. The second check is the same as above. Gift element should be more than 50,000 rupees. In this scenario, gift element is not going beyond 50,000 rupees. Therefore, IFOS income will become 0. Change the question. You have sold an asset worth 1 crore. Your consideration in hand is 1 crore. Stamp duty value is showing 1.2 crores. Check number 1. 110% of consideration. 110% of consideration is 1.1. Stamp duty value is 1.2. Is your stamp duty value under 110? No. Therefore, check number 1 not possible. Check number 2. Is your consideration less than 50,000? Less than 50,000? No, because it is 20 lakhs. It is 20 lakhs, not less than 50,000. IFOS income in this scenario will be 20 lakhs. IFOS in this will be 20 lakhs, 1.1 crore to 1.2 crores. Clear? Not clear? Sure? Be very careful. IFOS, immovable property is the most important thing. Because this will not be tested in IFOS, it will be tested in capital gains. It will be tested in capital gains. Inge tapa panna anga poidum. Okay, so you have to be extremely careful. These both are linked. These both are linked. Understood? Clear? Yeah. With this understanding, you have 3 kinds of assets now. You have 3 kinds of asset. One is money. One is specified movable property. Immovable property. Having these 3 assets, they have given certain exceptions to you. They have given certain exceptions to you. They have said, boss, if you follow these exceptions and you fall within that, IFOS income is not taxable. IFOS income is not taxable. I think in my book it is called as dirt min clot. In the amendment okay. It's called as dirt min clot. Dirt min clot. Okay. What is dirt min clot? D stands for death. D stands for death. You receive money on account of death. Who receives? Legal. If the legal heir receives any money on account of death, not taxable. I stands for inheritance. I stands for inheritance. If you receive any kind of gift on account of inheritance, not taxable. R stands for relative. Question to you. What do you mean by you are the assessee? You are the assessee. First relative for you is no other option. First relative for you is your spouse. Then your parents. Mom, dad. Then brothers and sisters. Then your children, son and daughter. Then if you are covering your parents, you will also cover your grandparents. Grandmom, granddad. Both mom side and that side. Both mom side and that side. Come to the right side. Come to the right side. You have your spouse. You don't have an option but to cover there. You don't have an option. Macha machi nichela cover paname gali pochna. Yes, you have to mandatory cover your macha and machi nichi. Mandatory rule. Yes, if you have covered your spouse, you also have to cover your own parents and their parents. So you now have to cover. Then you also need to cover granddad. Apart from this, you need to cover mom's, dad's brother and sister. Both mom's brother and sister and dad's brother and sister are coming into picture, and all their spouses. And all their spouses. Everyone's spouses are covered. Everyone's spouses are covered. Brother or wife, sister or husband, brother or wife, sister or husband, mom and dad are this side, understand? Okay. Grandmom, granddad are also couples. Brothers or wife, sister or husband, grandmom, granddad. In this, you will also cover any kind of legal heirs. Son's son, daughter's son, all covered. All covered. All the legal heirs are also covered. Understand what is not covered. Understand what is not covered. What is not covered is this side is not covered. Meaning, spouse, parents, siblings, not covered. Spouse, parents, siblings are not covered. Except for your children, no other children are covered. Except for your children, no other children are covered. Meaning, your siblings' children are not covered. Your macha machi nichi siblings are also not covered. Your parents, you are only the siblings. I'm sorry, your parents, you are only the kids. Your parents, you are only the kids. Parents, brothers and all, not covered. Anyone's kids are not covered. Most famous question in exam is Niece and nephew. What is niece and nephew? Mama oda paiyan. Mama oda paiyan. Mama means mom's siblings kids. Mom's siblings kids not covered. Okay. And in-laws on the side definitely not covered. In-laws on the side definitely not covered. This is what is a definition for relatives. This is what is a definition for relatives. Come to the next. T calls for transfer. T calls for transfer, meaning if something is taxed not regarded as transfer under capital gains, it is not taxable under IFOS except for one item. Except for one item, gift. Except for one item, gift. If you say gift is also not taxable in the section ke vartilla. Okay, so anything which is not taxable as transfer under capital gains will not be taxable under other sources except for gift. Except for gift. M means marriage. M means it only covers marriage. It does not cover anniversaries. It does not cover anniversaries. You celebrate how grand you want, but as long as it is an anniversary, you will never get exemptions. You'll never get exemptions. One of the most famous questions in ICI, they will come and say, boss, there was someone's 50th birthday. There was someone's 50th birthday. Wife was super excited. She got married with him again. 50th birthday kaga, they got married again, it seems. They got married again. The anniversary was celebrated as grand as a marriage, in which they received a gift worth 50 lakh rupees. Taxable, not taxable. நீ என்ன கிராண்டா celebrate பண்ணாலும் you're already tied with that person. Okay, if you want to get an exemption, first divorce, then marry again. You go get divorced and then marry again, then only no exemption. Unless until that happens, it is always taxable. That's a different story, that after you divorce, you'll never marry again. Never make the mistake once again in life, no? Yes. So you are death, inheritance, relative, transfer, marriage. I becomes individuals having private trust. Individuals having private trust. N becomes non-profit organizations. N becomes non-profit organizations. C is your COVID. C is your COVID. Any kind of gift you receive on account of COVID. When I say gift, they basically means medical expenditures. They basically mean medical expenditures. Any medical expenditures you receive because you have been hit by COVID. Because you have been hit by COVID becomes exempted from taxes. But here is where they have come and clarified that if you received it from other than employer, they have given some limit of 10 lakh rupees, I think. I don't remember. What is the limit, ma'am? 10 lakhs, huh? They have given a limit of 10 lakh rupees. They said, boss, if you receive anything more than 10 lakh rupees, everything becomes taxable. Everything becomes taxable. You have to receive only till 10 lakh rupees. You have to receive only till 10 lakh rupees is what the provisions are for C. L basically means local authority. Correct, huh? L basically means local authority. O means others. Others are not there for your exam. Others are not there for your exam. Last T means trust. Last T means trust, meaning you give a gift to a trust or you receive gift from a trust, it becomes exempt. It becomes exempt. Yes, yes. Dirt mean cloth can be revised. D means death. I means inheritance. R means, let's stop at relatives. It is self, spouse, parent, your siblings, spouse or siblings, your grandparents, spouse or parents, spouse or grandparents, your parents, siblings, your kids, their legal heirs, everyone's spouse. Everyone's spouse. Yes, this is what is R. Then comes T. T means transactions not regarded as transfer. M means marriage. I means individual with a private trust. N means non-profit organizations. Then C means COVID. L means local authorities. O means others. T means trust. T means, this is what the provisions are. Clear? Yes. This marks the end of your IFOS with just one small note on the middle. They have come and clarified that was, if at all a transaction is taxable under IFOS. If a transaction is taxable as IFOS, whatever amount you treat as an income under IFOS will be added to the cost of the asset. Will be added to the cost of the asset. And since you have added it to the cost of the asset, your period of holding will also start from today. Your period of holding will also start from today. A simple example, if you go to capital gains, A has given a gift to B. A has given a gift to B. The asset is worth 10 crores. The asset is worth 10 crores. Consideration is 0. Consideration is 0. You have two options. If A and B are relatives, IFOS income will become 0. IFOS income will become 0. In this case, the consideration for B will become 10 crores. The consideration for B will become 10 crores because it is cost to the previous one. Alternatively, if this was A to B as a friend, what will happen? A will treat it as a capital gains exempt from tax. For the purpose of B, this will become IFOS income taxable at 10 crores. Taxable at 10 crores. In which case, the IFOS income is 10 crores. His cost of acquisition now is 10 crores. But what is the difference? The difference is in capital gains, earlier scenario where it was a parent, the cost was 10 crores, but the period of holding was from the previous owner. Here it is period of holding from today. Period of holding from today, because a new asset has come into picture today with the new cost of acquisition for you today. While the cost will be the same, it doesn't matter. The period of holding will start from today. Clear? Not clear? Yes. Understand this. Keep it. Okay. The cost of acquisition will change. Let's change the example. Let's say this consideration is 10 crores. Consideration is, sorry, not SDV is 10 crores. SDV is 10 crores. Consideration is 8 crores. Is this inadequate or not? Inadequate. Scenario number 1, it was a gift from parent. It was a gift from parent. Cost for B will be. Cost for B will be. It will be the cost to the previous owner. It will be the cost to the previous owner. 10 crores is your SDV. I have not even given you the cost. Let's assume the cost is 2 crores. Let's assume the cost is 2 crores, in which case the cost to the previous owner will be 2 crores. Correct? So for B, the cost will become 2 crores. Period of holding will start from A. Option 2. A and B are friends. A and B are friends. Your consideration is 8 crores. Your stamp duty is 10 crores. Differential income is 2 crores. IFOS income will be 2 crores. So no. IFOS income will be 2 crores. In this IFOS income being 2 crores, your cost of acquisition now becomes 10 crores. Why? You paid 8 from your pocket, 2 became IFOS income. So cost of acquisition becomes 10 crores. In this, what will happen? Period of holding will start from here. With this, we'll end the class for today. We will come back and we will do IFOS sums next class. Complete the dividends part on Saturday.